Good morning and welcome to the first knowledge series organized by SEBI as part of the Manthan Ideathon program. My name is Sumit and I head the fintech initiatives at Startup Reso, and I'll be your host for the today morning. With an idea, and SEBI in association with BSE, NSE, NSDL, CDSL, KFintech, CAMS, LinkedIn Time, MCX, and NCDEX launched the 6-week-long Ideathon program Manthan on 30th of March 2022 to promote innovation in the securities market. Manthan will facilitate creation of a pool of ideas around innovative solutions revolving around the securities market. We are joined by industry stalwarts to talk about RegTech and securities market, technology and transparency in the markets and commodity markets. With that, I would like to welcome Mr. GP Garg, Executive Director at SEBI, to give the opening remarks. He heads the information technology in SEBI, and he has several important assignments in SEBI since joining in January 1994. He has been closely associated with SEBI's initiatives on financial literacy, investor education in the country. Mr. Garg played a key role in establishment of the national institutions of the securities markets. Welcome, Mr. Garg.
Dear audiences, good morning, everyone. We in SEBI believe that encouraging adoption and usage of financial technology would have a profound impact on the development of securities market. Fintech can act as a catalyst to further develop and maintain an efficient, fair, and transparent securities market ecosystem. The technology breakthrough in the field of cloud computing, AI, ML, data analytics, etc., have driven innovation and led to the growth of financial technology or fintech. In order to promote innovation in the securities market, SEBI has issued sandbox framework, which provide access to test environment with MIs and regulatory environment with SEBI. I request all of you to take benefit of sandbox framework by visiting to Innovation Sandbox portal at www.innovationsandbox.in. Further, to facilitate innovative ideas and identify various themes for the continuous innovation, SEBI has launched Manthan event, for which I have honor and privilege to be here. Manthan is a 6-week-long ideathon by SEBI in association with BSE, NSE, NSDL, CDCL, KFintech, CAMS, LinkedIn Time, MCX, and NCDX to promote innovation in the securities market. Manthan will facilitate the creation of a pool of ideas and innovation solutions revolving around the securities market. Going forward, workable ideas emanating from Manthan may translate into possibilities and prototype through a hackathon. So please be ready for hackathon after Manthan. During the Ideathon event, interactive knowledge sharing sessions will be organized for registered participants using webinars. These knowledge sharing sessions will give you insight as well as enhance your knowledge base. Therefore, in turn, it would enable all participants in their submission for Ideathon. The first knowledge sharing session is scheduled today. We have 3 separate sessions on varying topics related to securities market, covering from SupTech, RegTech, that is use of technology to increase greater transparency and disclosure in the market, and also an explainer in the commodities market. So it covers both securities and commodities market. I would like to invite all of you to benefit from the experience of these speakers and actively participate in the Ideathon event and make it a grand success. I look forward to welcome you in this Manthan program, and I'm sure you'll make it a grand success. Thank you.
Great. Thank you so much, Mr. Garg. And with that, I would like to just briefly talk about the overall Manthan Ideathon program, give a brief overview in terms of what is it in a store. And with that, like as I mentioned, like SEBI launched this program on 30th of March earlier this year. And we are looking at innovative ideas across these 4 key themes, which is investor education, protection, and ease of investing, securities market development, market regulation, and integration within the financial ecosystem. And with that, there are exciting prize up for grab for all the participants. There are prize money worth up to 5 lakh rupees. And along with that, right set of goodies and participation certificates is also there for all the applicants who finish their applications. In terms of the key dates to remember, we are right now on the 9th April, which is the first masterclass, and the end date to apply for this program is 14th of May. So make sure you finish your applications and submit your ideas before 14th of May. And in terms of who should apply for this program, so if you are a startup, a finance enthusiast, a management candidate, or a professional, or a student studying anything, the idea is if you have a relevant idea which focuses around innovation in capital markets, we want to know, we want to hear from you, we want to listen to your ideas. With that, here is the brief agenda for today's session, and make sure you submit your ideas. And without further ado, I would like to welcome Mr. Arpit. So Arpit is the co-founder at Signzy. He has studied ILS at ILS Law College and completed his LLM from Pune University. He is the co-founder of Signzy since 2015, and he has with the aim of creating a trust mechanism in the digital economy. He has been listed at Forbes 30 under 30. Signzy works with almost 45 plus financial institutions to help them digitize their customer journey. Over to you, Arpit. Welcome to the session.
Hi, thank you. Thank you so much, Sumit, for inviting us and calling us on the panel. And hello to everyone who's there in the audience. See a very large number of people. What I'll do is I'll also start sharing my screen. I'm going to talk about RegTech, which we are doing and have a fairly good experience in. Also, will share some experience from my past in terms of how we have seen this evolve and how we see the future of RegTech and SupTech. Just bringing up my screen. Sumit, is the screen visible?
Yes, it's visible.
Great. And just a disclaimer, I mean, I'm not used to doing knowledge sessions, pretty much heading business, so largely pitching companies. So this is one of my few attempts, so maybe not the perfect one. All right, so let's understand first the difference between RegTech and SupTech. They sound similar, they look similar. Overall, while RegTech is very much associated with financial industry, but as a definition, it covers any company which would be building technology to comply with either regulations or to internally manage compliance and risk of our organization. So RegTech is largely a company which therefore supports the functions within a certain business operating in a regulatory environment. And this can be beyond finance as well, while finance is the largest use case because financial industry is the most heavily regulated industry, has the highest risk of fraud. But having said that, you will see regulation technologies across spectrum, which includes medical, which includes manufacturing, includes gaming, etc. SupTech, how's different is that, and it is a very, very new emerging field. In fact, I just heard this term a year ago, so it's that emerging a field. And it is now referring to these new emerging technologies, which is helping the regulators do better supervision of the companies which are falling within their regulatory ambit. And therefore, while the RegTech is for the company, helping the company, SupTech is a new age of technology, which is to help the regulator perform their functions. And we'll go into more detail and explain, but wanted to give you this overall viewpoint because these two terms are used interchangeably, are used in the same breath, but are actually two very different kind of functions. Underlying technology is very, very same, and I'll talk more about it. But the objective of these two fields are actually very, very distinct. And I have been a lawyer before starting my company. One of the things I've always believed, and it is also true historically, has been proved by data, is that regulations actually lead to more growth. Being in the industry, being part of the whole startup ecosystem, we continuously actually hear this, that regulations are stopping innovation. Because of regulations, growth is getting the growth is not accelerating. But actually, if you look at historical data, it is the opposite. It is always the regulatory environment which has created infrastructure in order to for the startups or any economy to grow. And the logic and reason behind it is that if you understand why a regulation should be there in the first place, is to protect the insecurities in that market. In some way, when you are starting any new market, like SEBI was born to build trust in the stock exchange as a market, because before SEBI, yes, there was still trading happening, but the trust of the consumer in that is very low. So if you take an example of startup investments, uh, there are companies which invest in startups, but they do very long due diligence, which increases the cost of such investments. It makes that market inefficient because the amount of knowledge that is needed to make that investment is not available. In fact, you'll see a lot of stories of some startup got busted, this happened, and it's largely because it is unregulated, which means that eventually it is dependent on the individual due diligence, and that is the challenge in unregulated markets. And because of that, the growth of such a market is always limited to few risk takers. And that is what a regulator or regulation solve for, that they bring that trust in the market. They enable that due diligence. So for example, if uh, if SEBI has given license to a stock exchange and I end up buying certain securities on a stock exchange, I have certainty of that delivery. And similarly, if a bank is licensed by the RBI and I end up transacting with a bank, I am insured because of that license that this money would be deposited, would be available to me in future. And as a person or as an individual, I do not need to do my own due diligence and spend that cost. And therefore, it not only enables trust, it also significantly brings down the cost of doing that business, and therefore enables the growth. And this is a very less understood fact, but historically, if you look at markets which are unregulated, like the P2P lending in China, they eventually, while they may grow uh, you know uh, through amazing acceleration in some years, but there it leads to a bust eventually, and that has been proven. And therefore, across the world, all good economies, before whenever a market is growing, they would want to put regulations in place in order to ensure that the growth is sustainable over a very long period of time and is not for few individual companies. uh, and having said that, and why I wanted to give that perspective is because this objective of regulations is what defines how a regtech and suptech will behave and what objectives will it solve. We'll start with regtech first. Uh, in case of a regtech, because the idea is to help a company either comply with the regulations or help that company manage their risk, internal risk, more effectively. The large part of regtech is driven through the business need. What does that mean is, so for example, I as a business want to accelerate my customer onboarding, and I realized that one of my bottlenecks for customer onboarding is that my current process of KYC is very manual, tedious. I would want to make it more efficient in in order to ensure, of course, compliance with regulation, which is given, but actually to meet a business need, which is get more customers onboarded faster. Similarly, there may be a company which is doing lending, and during the lending process, they may have to do credit risk of the individuals. And now in such a case, they may use a technology which automates this credit decisioning. And again, the idea here for that company is not really to put that technology only to comply with their internal compliance, but is really to ensure that because of this fast credit decisioning, they are able to onboard customers, give loans faster, make it more efficient. So if you look at RegTech technology, if you're thinking about building a RegTech technology, please understand that yes, at the base, you will have to make a technology which complies with the regulations, which helps the business comply with the regulation. But eventually it will get adopted if it makes a existing business process more efficient. If your RegTech technology makes the process less efficient, then it will not get implemented. I'll take an example of our company actually. When we are in India, we find video KYC as one of the most hot selling product because if you are not doing video KYC, you will have to physically go meet the customer in person, and therefore the cost, time, everything increases. But when we were doing the same thing in US, we realized that video KYC actually in US increases that burden, because in US just an SSN check is actually a good enough compliance with the regulation. And therefore, if you suggest them that beyond an SSN, you also need to do a video KYC, it actually increases their burden and makes the process more difficult. So please understand, if you're working on RegTech technologies, the idea is to comply, but at the same time, make sure a business process becomes more efficient, it saves cost for the business, or makes the user experience better. Of course, and we also were told about a lot of technologies that are being looked at. Most of RegTech would be based on big data, either using some amount of big data to come up with some rules or come up with some analysis. It will be using AI, because a large part of RegTech is uh, trying to do what a human should have done. So, for example, if a credit decisioning was to be done, a human was doing it before, and now the technology is trying to do it. So, a large part of it is based on AI ML. And because a lot of regulatory processes earlier required a human to human connect. So, for example, the customer connecting to the business representative, which now needs to be replaced to a voice bot, can tomorrow be a AR, VR, the whole metaverse that we're talking about. So you may have virtual avatars helping you on board, helping you do the post onboarding processes, etc. So a large part of it is within the AI as a entire segment. In India, of course, we are seeing the regulators themselves being very, very proactive, and you have various such initiatives, right from Aadhaar, GST, DigiLockers of the world. You have, in fact, for the longest time, in the vision of SEBI, we had instituted a central KYC repository, which I think was a phenomenal move and enables amazing amount of speed of onboarding across different participants within the market. And so if you see India, there is a huge amount of leap that we are taking within this space. And if you need to look at building a RegTech, it should be somewhere taking into account this amount of innovation which is happening and continues to happen through the regulator. Now, why, while we are talking on RegTech as a field, also want to touch upon, and I spoke about it, is that eventually you need to enable certain USPs for the business, and there are technologies which are emerging, will have to be adopted. It's not now a question of what, it's a question of when. So all businesses will have to eventually, because they will be otherwise outcompeted by their competitors, will have to implement RegTech in a very, very big way. And the reason is that once the businesses which are implementing RegTech uh, will see significant efficiency, will see significant cost savings, and therefore will become more competitive than companies which are not implementing RegTech. So anyone who's working on RegTech today at least should work on technologies which are emerging of the future, which includes cloud, includes AI. It also includes AR and VR, which is augmented and virtual reality, because whether we feel it is Matrix, and I mean that movie came out in 2000s, but the truth of today is that a lot of young generation is spending hours in a day in a virtual reality. So that's going to become real very, very quickly, even within the regulatory space. So while we look at RegTech as a field for regulations, I think the idea I'm trying to leave everyone with is that start thinking it more from perspective of meeting business goals and meeting consumer needs. Uh, RegTech, I think, while this is a very new term, we just heard, I mean, we started hearing this term 5 years ago. And this has taken time to shape up with respect to large other businesses. It is a significant business today, and largely because the regulatory environment has increased over a period of time. Regulators have become very comfortable with new technology, and we heard speaking about the sandbox. I think that's a brilliant initiative where the regulators in India at least are welcoming new technologies, are open to the idea, and because of that, massive unlocking has happened. And in a very short period of time, it is more than a $1 trillion industry globally, because we see this trend globally. In this, one of the good, I think, emerging trends which are seeing in RegTech is that most companies which are enabling RegTech are also in some way leading to more comfort for the regulators. It's a very, very nice trend. And I think I would also want to give that credit to a lot of companies like us in our space, that we have operated in a manner which has allowed the regulators to feel that trust, that this is not something where we are trying to bypass regulation. This is not something where we are trying to take shortcuts, but we are really enabling regulations. We are really enabling compliance, but at the same time using technology to make it more efficient. And I think it is that behavior in the ecosystem which has enabled even regulators to find more trust and open up more and more. And we've seen this trend over a period of time. And my request again to anyone who wants to do RegTech in future is that please understand that the future of a RegTech company will depend on how much trust a regulator will eventually have on it. So no shortcuts, no trying to bypass. The idea should be to in fact increase compliance with better user experience. Uh, Talking about the ecosystem as huge, India is slightly still a very small market for RegTech. Globally, this is a very large market already. One of the reasons I think for that is that in some of the Western markets, there is a huge cost of compliance because the human cost is very, very high. And therefore, the markets which are emerging in West, and that's traditionally for any software which is automating a human process in the West, is very large. But India is, I think, one of the most emerging markets, because I think we are in a state of boom when it comes to our financial markets. We are seeing a 50% growth in, if you see the emerging sectors within finance. So because the West is already a very large financial market in some sense, the pie today is very large itself, and therefore looks large. But as a company, as Signzy, we are betting very, very big on India, because we see that the kind of growth you are seeing in India in the financial market, you're not seeing anywhere else globally. And therefore, we would suddenly become very, very significant in years to come. But if you look at the problems that people are solving globally, large part of the problem solving is KYC AML. That remains the number one problem within RegTech. And the reason for that is because onboarding a customer is the primary need of any business, because the money comes in when I onboard a customer. My revenue starts when I onboard a customer, and any technology which helps in doing that is definitely which people want to use. The second is that the reason why KYC AML exists is to prevent money laundering. And there has been a lot of slippages on this part when it comes to large institutions, in fact, very, very large financial institutions. And there have been massive fines running into hundreds of millions of dollars for violations of money laundering norms. And what money laundering norms basically means is that after you've onboarded the customer, you need to keep monitoring that customer and their transactions to identify whether there is a possibility that this customer is using illicit uh, illicit money in some ways, which is coming from activities like drug trafficking, can be coming from activities like criminal, and to monitor that and monitor that source of fund is an obligation which is being put on different financial institutions. And to meet that obligation, there are certain rules, regulations. Um, and those violations have led to massive fines. So a lot of companies now are helping these financial institutions manage these compliance better, which is monitoring over a period of time. And you have companies like Comply Advantage, which is a UK-based company, which is very big in this space, helping companies do that. You have Alloy, which is a US-based company, which is also helping do that. The other emerging space is authentication. What you see today across is that whenever we are doing any payment transaction, we are logging in anywhere. You have this OTP which comes on your phone. One of the risks which has been identified is that OTP by itself can be captured, it can be hacked, and has been one of the problems of fraud across because of SIM swaps. So there is new emerging technologies which are helping authentications, whether they are for payments or for any other transactions. And these authentication technologies which are coming up, like you have Smile Identity, and US has very big companies inside authentication. You also see large players like Apple, Microsoft also entering into the authentication space. It is a mix of biometric, device IDs, your IP addresses, in fact, even your behavioral. There is a company which, from the way you are using your phone, the way you are, the pattern you are creating while using the phone, will try to identify you. And therefore, a lot of these authentication technologies are also very emerging, because everyone believes that tomorrow there will be everything which is digital, physical will be very, very less. And therefore, one of the key problems to solve in this complete digital world will be, how do I have done your KYC once, but how do I continuously authenticate you over a period of time? So that's also becoming a very, very emerging field within this space. Uh, Now switching to supervisory tech, as I said, it's a very emerging field of technology space. I have started hearing it very, just few years ago. Largely, it refers to where a regulator is now implementing technology to supervise, and I know regulators have been doing it for a longest time, but I think people have just started calling it soup tech now. And within that space, I think the underlying technology remains slightly similar. So the use of big data is common, use of AI ML remains common, of NLP remains common. So you will see that almost similar technology will be used, but the objective is actually very different. So while we talk about RegTech, in order to meet compliance, the objective was to also augment a business need, to make consumer life better. That is, for SupTech, actually the idea is that how does a regulator make their life easier, reduce the time, make it more efficient to do their monitoring. So if you look at the function of a regulator, they would have hundreds and hundreds of companies to whom license has been given. Within that license conditions, there would be conditions which need to be met, certain categories of risk, certain thresholds, and those are monitored by certain submissions, sometimes are done through inspections. And this is a very tedious manual process, and used to be, at least. But what we are seeing in India, at least, is a large part of this is getting automated. If you see the ROC filings, the GST filings, now earlier I remember being a lawyer, that when you had to submit your refund for VAT or your refund for CST, you had to do calculations and make that payment. Today in GST, it's automated. In fact, you can't even change it. It's decided based on the GST filings made by your vendors, how much refund is available to you. So you see that a lot of technologies which are helping the regulator ease the burden of their supervision, ease the burden of their monitoring, and helping them to do it faster, is the whole area of SupTech. It is very emerging. If you want to build SupTech, please understand that the set of your customers in some way are limited. There will be regulators. Yes, there'll be huge amount of work which is involved there. But in that sense, you'll be building something for the regulators, which are limited in number in any geography or in any sector. So when you're building it, the idea should be to how to align better and better with the regulator. It should almost be co-built with the regulator, because you don't want to end up building something which regulators don't feel is the right thing to do. And moving on. Yeah. In SupTech, because it's not very consumer driven, it's not something where it's directly talking to the consumer. There is large part which is data collection and data analytics. What a regulator would try to do using a SupTech is one, understand whether the companies are uh, performing the compliance obligation, and the second would be using enough data analytics to identify the risk very early. So one of the things that any regulator is trying to do is to identify systematic risk early and to stop them and prevent them. And that's one of the things that data analytics can solve with the amount of data which is coming in through different, different submissions. They can identify that risk quickly, can find it out faster, and can take action. uh, Across the world, I think India is the fastest. Don't want to show that on a slide because I mean we are far ahead when it comes to at least SupTech. While RegTech, I think in Western market companies are very big, but when it comes to SupTech, I think our regulators have been way ahead when it comes to adoption of technology. And I think that's very visible to anyone who might be dealing with any other geography, any other regulator. Almost everything is automated. All submissions are automated. No one needs to visit any office anymore or submit any physical documents anymore. And most of this monitoring also has been, fully digitized. If you have been reading income tax department, which is now using AI ML to detect anomalies, and earlier it used to actually do it sample basis. So out of 10 submissions, someone will pick one and then try to see if something was wrong. But now, rather than sampling, they have implemented a data analytics program which runs across all submissions, and therefore they have become even very fast in recognizing if there are anomalies. So if you look at India, I think we are the fastest SupTech market in that way, where we have come up with so many innovations as a regulator across all regulators, that we have made the whole economy on a fast track path. And I believe that the kind of infrastructure which is getting built in India today, especially in financial sector, is far ahead of anyone which is thinking anything globally. This is one of the case studies, in fact, we had, and wanted to show you how RegTech can help. And we talk about it a lot, and we spoke about it a lot earlier. And it has to deliver in terms of numbers. It has to make the life easier. So we did one with ICICI AMC for the B2KYC onboarding, which is enabled by SEBI now. And the idea was that how do we make it so smooth that customers can onboard faster? And we saw tremendous growth just in 6 months, 8.5x kind of growth in terms of number of applications you can onboard. So the eventually a RegTech or a SupTech has to build in efficiency. The key goal, of course, is compliance, but at the same time, if it does not lead to efficiency either for the regulator or for the business, that may not fulfill its objective of a technology shift. So I think here is where I will also like to pause, take in questions. I've taken up a lot of time. Don't want to bore people with the one-way lecture.
Uh, Great. Thank you so much, Arpit. I think we have one question specific on the from the attendees. The attendee wants to know a bit more about Signzy, what work you have been doing with various financial institutions, a detailed introduction.
Okay, so at Signzy, we are a company which is in this space of customer onboarding. What we help is that, so there are regulations which are making companies like banks, like AMCs, like stockbrokers, to comply with KYC norms. And to do that, there are certain steps. They need to do the check of the identity. They need to make sure that the person is given the consent, and there's a long list of regulations. And what Signzy does is that we automate that process. We build technology both for the front end for someone to onboard, do their entire KYC, and also the back office where someone can look at these data, have the entire audit trail, have the whole decisioning done in real time. So we automate this entire process, and we do it across. We do it for banks. So we're working with all the top banks in India. We're working with the top AMCs in the country. So a large use cases across industry.
Great. I think there is one more specific question. I think we would like to invite the attendee on the stage for that. Hi, Sandeep.
Hi, everyone. I just want to ask that if I can get this presentation for my reference. Is there a possibility?
Yeah, sure. Why not?
Thank you, sir. Thank you. It was a nice presentation on or detailed on RegTech and supervisory technology. You explained nicely.
Great.
So I want to learn more towards this. Have more clarity towards the regulatory framework and also the supervisory framework. So I will also refer to the SEBI's circulars as well as for supervisory. Where can I get more data?
Yeah, Sandeep, I think supervisory is a very emerging field. I think, and therefore, because it's not, to be honest, in public domain, because what regulators do or how regulators, do their functions is something which is not very easily available. Therefore, when even I was talking about SupTech, I said that if you have to build SupTech, you should align very closely with the regulator, which means that you should take part in their sandboxes. You should work very closely to even understand what the problem and challenges they are facing. Unlike a RegTech, which is helping the business and the consumer, you may be able to understand the problem as a community, but to understand the problem sets of SupTech, you will have to become very close and work very closely with regulator as part of, for example, this Ideathon for the sandboxes. So aligning with the regulator becomes very key and crucial if you want to do anything in SupTech.
Okay,
Great.
sir. Thank you.
I
Thank you so
think
much.
thanks a lot, Sandeep. You can like you also you can get the recordings of this session like post on YouTube as well. But with before that, I would like to welcome Rakesh on the stage as well. Rakesh, please introduce yourself and let us know what's your question.
Okay, am I audible?
Yes, you are.
Okay, thank you very much. This is Rakesh Tirath from Delhi. I am an IT professional with about 35 years experience. My question to Arpit is that aren't the two areas, the RegTech and the SupTech, integrated in the sense that, let's say a very simple example that SEBI has a requirement that the client opening form of the broker has to follow certain norms. And we know that, there are challenges. Many brokers have their own version of client opening form. So if, using technology, the client opening form is standardized, both the RegTech and the SupTech requirements will be met in an integrated manner. So similarly, there are lots of examples like this. So over to you, Arpit.
No, Rakesh, you're absolutely right that RegTech in some way helps regulator meet their own functions and requirements, and that is the actual work also of a RegTech in order to meet compliance. But SupTech is how different is that it is a technology which the regulator adopts. So, for example, if you're doing a SupTech startup, your customer is the regulator. I'll give you an example that the police department in India implemented a facial recognition technology to recognize different people across domains. So in this case, it is the regulator or the government in that way, which is the customer, which is the your eventual paymaster, and they are implementing the technology for their own benefit. And yes, the underlying technologies, for example, in face recognition is same across in RegTech and SupTech, but the your customer is different. Your objective that you're trying to fill is different, and therefore I feel SupTech is a very customer aligned field, or what you're trying to do for a government, regulator, certain departments. Whereas RegTech is in general trying or helping customers to comply or clients to comply with regulations. So yes, you're right. You're absolutely right that RegTech enables compliance, but SupTech is basically when the regulator kind of pays you to help for something of their own problem.
Thank you very much, Arpit. Appreciate your answer.
Great. Thanks a lot, Rakesh. I think so. There are a couple of more questions as well on the Q&A tab. I would like to take selected few. There is one specific question from Rajesh. He says that for SupTech there would be more dependency and coordination with various agencies. So how do you tackle this challenge while working on an idea? Will it be left to the regulators to manage it, or will it be on our side?
That's a brilliant question. I think in any being a businessman, I think I like to at least put two viewpoints. I feel that never be dependent on any outside help. If it comes, it's great. It should be a bonus. But you should be able to think and build a business which is completely dependent on your own capabilities. How to address SupTech? You're absolutely right. It is where the government buys you, but there are enough technology which is being bought by government, especially if you see in India, in fact even abroad, even in US, in Europe, that government is also buying technology. One way to do it is that there is RFPs which have been coming out for the longest time. There is a lot of ideas that the regulators are putting in ideathons, hackathons. And for example, we were part of this IFSCA hackathon, which just concluded, where they were trying to look for a central KYC or a unified, not central, but unified KYC. And we were winners of that, and we will be helping them build a unified KYC. So if you look in some way, right, the agencies which are also part of this entire initiative, which are CRAs, or also in some ways helping regulators supervise, and those are also SupTechs. So if you want to do a SupTech, you will have to very closely listen to the regulator through various channels. Of course, if you have relationships, if you can, depending on your experience, that is always a bounty. I've seen Indian regulators being very open in general. So, you can always go meet them, ask them what are the problems, how you can solve. But if you can't do that, go through RFPs, which have come out across a regulator. It may be hard. You may have to go through a lot of document data, but you will at least find problem sets that the regulators are trying to solve.
Great. I think that's quite amazing. Thanks a lot, Arpit, for those amazing insights. There are still many questions coming in, but with the to keep the time in check and to just make sure the agenda moves ahead, you feel free to stay around, and you can answer the questions on the Q&A tab below directly. And with that, I would like to welcome our next speaker for the day. Mr. Navneet Munot. Mr. Navneet Munot is the MD and CEO of HDFC Asset Management Company. And we are here to discuss about how technology can increase the greater transparency and disclosures in the market, corporations, CRAs, and market intermediaries. Hi, Mr. Navneet.
Hello, how are you?
Great. Welcome to the session. I would like to, without delaying any further, I would like to hand you over the mic and take ahead with the conversations.
Thank you so much for having me, and it's great to be with all of you this morning in Manthan. Sincere compliments to SEBI and all the ecosystem partners to come with this Ideathon for fostering innovation and enriching capital markets. I had the opportunity of attending the inaugural session a few days back, where chairperson said that everything begins with an idea. And she talked about that in India, we have entrepreneurship in abundance. And if you add technology with that, an innovation ecosystem can get developed. In Silicon Valley, they say that if you put enough capital with the engineering prowess, any problem can be solved. And in Indian context, I would go with her where she said that it's the entrepreneurship plus technology. But another way of putting it could be, if you put purpose with passion, any problem can be solved. And today we are talking about a specific purpose. And if you put some passion, and it was good to see the presentation before about the RegTech and the SupTech, and I'll talk a little bit more about it with few specific use cases where some of you can work and can help the industry, can help us, can help investors, can help regulators, can help the wider society with your technology, with your ideas, with your passion. But that purpose should be, how do we enhance the transparency and disclosure in the market? So if you put this passion, this purpose, along with your passion, I'm sure a lot of ideas can emerge, a lot of solutions can emerge, which will go a long way in improving our economy and in taking our economy and capital markets to a different level. She also talked about the democratization of finance and mentioned that there could be ideas pertaining to financial inclusion, to investor education, investor protection, and variety of other things. And maybe some of the ideas I will discuss can go a long way in terms of if we are able to come with some solutions that can help the industry and expanding a lot. There was interesting examples from the previous speakers on how the video KYC, for example, or some of the other things that partners like Signzy have done. That the various solutions came, particularly during the time of COVID, where it was not easy to do the business the way we were used to do before March 2020. But I think COVID was also kind of like brought in a lot of innovations into the field. I mean, in India, one of the most interesting aspects over the last few years has been that we have turned from the most data poor society to the most data rich society in the world. Now we have ubiquitous data. Everybody has got a phone. I mean, even if it's a feature phone with the internet and the other abilities, and you add the biometric card with it, I think the potential is tremendous. And in a country where you have people who are tech savvy and financially underpenetrated, I think there is a great opportunity for all of us to do a lot more over the next several years. So, I mean, why the importance of disclosure and transparency? As someone rightly said, trust is the oxygen of capitalism. The entire capitalism thrives or stands on the pillars of trust. It has to be the trust between the two parties. It's trust between the regulated and the regulator, trust between the business and society, trust between the customer and the company, trust between the vendor and the company, trust between the investor and the investee business. That trust is the fundamental pillar on which capitalism thrives, on which markets work, which is the most important ingredient. And that trust comes from transparency, from truthfulness, from better disclosures. And we'll talk a little bit more about it. I mean, if you look at the overall finance street, whether there is a bank or a mutual fund or insurance or a stock exchange or depository, or broking, or maybe a home, I mean, the NBFC, HFC, other fintechs, we look at this entire street. What comes to mind is like the importance of transparency and disclosure. I mean, I compare our business, let's say, or the way customer deal with us. Somebody sitting in Bhagalpur gives money in our fund. They have no idea in where we are, how are we investing that money, but they have a faith and the trust that the day they want that money back on T+1, putting the redemption, next day money will be credited in their account, or the same thing with the bank, or same thing with most of the other institutions. That's a fundamental pillar on which the financial markets grow or thrive, and that's very, very critical. If I have to give an analogy, it's like a hospital where you go in an operation theater, if you're getting an appendix or anything done, and you've got an anesthesia, and after that you have no idea what the surgeon is doing to your body, but you have full faith on the surgeon because you trust the hospital, you trust the individual, you trust the ecosystem. This is very, very similar in financial system, and that's why financial system grows. Now there, I mean, if we don't have the transparency, if we don't have the proper disclosures, obviously that trust, the way you would like to have, the way a patient will have with a doctor, won't emerge. And if that doesn't happen, the growth opportunities will surely be very, very limited. So I just thought that I'll give that analogy of a patient and doctor with a consumer of, let's say, financial services. And that consumer could be the consumer of financial services. It could be an investor who's been putting money, or it could be a regulator who's trusting the regulated entities, or a wider society which is looking at this data, which is looking at the disclosures that we produce. I just thought I'll talk for a few minutes the importance so that we get the context right. And when we are building the solutions, we understand the importance and where we are coming from when we talk about the SupTech or the RegTech or the technological solutions for disclosure and the transparency. This is an Edelman Trust Barometer. It's a huge survey they do across the world. Of course, India ranks substantially higher than even several of the developed markets. And I'm sure, as you know, I think we have been extremely well regulated over a very, very long time. I mean, our regulators have been far ahead of many other regulators in the world in terms of the overall level of regulation. But still, if you notice, one of the things that financial services in general score much lower than many of the other industries. People have a lot more trust on sectors like technology and education and healthcare than, let's say, financial services. Of course, social media is much lower. It has improved. It's been improving in the last few years, but we have a long way to go. And that's where the importance of quality disclosures and improving the standards of transparency. If you see the trend over the last 10 years or so, and look at the last line, the numbers in red because they were below 50. And I think a big impact happened in 2008 when the global financial crisis happened, and some of the mightiest of the organization like the Lehman Brothers and many of them went belly up. The trust in the financial sector came down very, very substantially in general public. Over the last several years, globally, with a lot of efforts by the regulators, as well as the industry and media and wider public, the trust has been improving, but we have a lot to catch up, and we need to catch up over the next several years. More relevant in India, because large number of investors are yet to invest, particularly when I talk about the capital market instruments. I think whether the penetration of mutual funds or insurance or pension and all of that is much lower than many other places in the world. And that's why it's very important that the industry or the sector keep building trust. And again, I repeat the same point that quality disclosures, timely disclosures, the transparency are very, very critical to build this trust. That's the only way the industry can grow. And if this was another interesting, it's a very, very long survey. You can Google and get this, but just picked up 2 or 3 slides from that. And it was interesting that whether it's family owned and whether it's privately held, even the publicly traded, they are or the state owned, across the board, it's been the ranking is improving, or the trust barometer survey is showing improvement over the last few years, but we have a long way to go. The point I wanted to make that even in publicly traded versus, let's say, privately held or state owned versus family owned, the difference is not very high. So we have a lot to do, even where, let's say, publicly traded companies are concerned, where a lot of data is in the public domain, because there is a lot more expectations of the investors that have to be met. Because when you come into the public domain, obviously the expectations go up. Not that family-owned businesses, people have more trust because they are better on disclosure or the better on the transparency. Just that the expectations go up a lot more when you are publicly traded or you are state-owned. Another survey of ACCA, very interesting that 69% of people said they are skeptical about the information companies provide since the financial crisis. And as I said, that the trust really got broken in 2008. when several of the large organizations really disappointed investors. They went belly up, and regulators found it very, very tough to manage the overall crisis. They did a great job after that, but I think still investors believe that they are skeptical about the quality of information and how to improve that, and what is the role technology can play that. I'll come to that in a minute's time. And 63% believe that management has too much discretion over the financial numbers they report, and investors find it think that I think that there has to be a lot more, I would say, clarity, a lot more consistency, a lot more they expect a fact-based information to break the cycle of distrust. And that's why it's very important that every institution must provide information which is very, very trustworthy. And it's a job of everyone in the ecosystem, not only the regulation, because regulation can only work up to a point. I think it has to be a lot more work done by a lot of other partners, and particularly the role of technology is very, very critical. So why the importance of the quality in the disclosures? Because investors depend on information for their investment decision making. I mean, we have seen in India over the last 2 years or so, demat accounts going up from 4 crores to 8 crores. I mean, another 40 million demat accounts have got opened. Mutual fund folios have grown from 7-8 crores to now 12-13 crores. It's almost a 50% increase, 100% increase in the demat accounts. Newer investors have come to the market. They completely trust whatever is publicly available, and that's why it's important that for their investment decision making, the data that they are reading is trustworthy, whether the market data, whether the company's data, or any other data from any of the ecosystem players. And as I've already talked about the 2008, and particularly in 2008, what came to the fore, and that's where a lot of opportunities for the SupTech and the RegTech is that transparency on exposures, on risk, on interlinkages of the risk, what kind of uncertainty, the leverage that people had was clearly lacking. And that's why, as I said, several institutions went belly up, because I think a lot of this wasn't really, I won't say available to the investors, but wasn't really easily, I would say, accessible or easily interpretable for a large number of investors. And that's why they kind of went wrong. I'm not putting the entire blame on the disclosures for the crisis. There were a variety of other reasons. And as Warren Buffett said, that it's only when the tide turns, you know who is swimming naked. So I think everybody in the system was swimming naked. But I think this is something that that is important to know, that disclosures and the transparency is very, very critical if we don't want something like that to recur again. And the financial markets, as I said, the efficiency and effectiveness depends on the quality of the investors' pricing and the capital allocation decisions. That affects the efficiency and the effectiveness of the financial market. The job of financial markets to allocate capital efficiently, that can only happen if we have the right kind of information and they are able to price the security well. So as I said, that the lack of transparency in institutions has implications for investors' trust. And if investors' trust is not built, if the savings are not getting converted into the investments, those investments not coming into the capital markets, not getting available to the entrepreneurs, both in the form of debt capital and equity capital, then obviously the growth would be limited. Investments won't happen, and the growth potential of the economy really gets impacted. And that's where the importance of the quality disclosure. So to summarize this, transparency and better disclosures improve trust, which is very critical for a fair, efficient capital market, and which is very critical for the growth of the economy and for everyone in the system. Now, what do investors want? Just on 3 slides, again, I've been taking from a very big survey. When we talk about that investors want quality disclosures, they want better disclosures, what exactly they are looking at and where are the areas of that could be focused upon. So in investors' top priorities, what they have mentioned is emphasis of matters, greater emphasis on matters of importance, the materiality, including an improved MD&As in every annual report. Management has to give management discussion and that better explains the current period results and expected future results. It's a long text, but along with that, I think if it is a better explanation and a lot more on what is material versus a long speech, which several of those things may not be very relevant. So I think the matter of importance is very critical. And the other thing they mentioned is the improved financial statement presentation with improved disaggregation and cohesiveness. So let's say if you are looking at accounts payable, but then you have an ability to disaggregate it across, let's say, your different businesses, across your time period, 0 to 30 days, 30 to 90 days. I mean, I'm giving a very crude small example, but across you have a massive several number of pages on the financial statement. How do you provide better disaggregation, and then how do they relate one to the another? That cohesiveness is very critical. In terms of communicating that, the effective communication, what the investors have voted for is increased use of tables and charts to better display information. Visualization techniques have improved quite a bit. I think there's a lot of opportunity for people to look at the amount of data which is already available. How do we present that to the investors over a period of time? Part of it, what the companies do, part of it, what, let's say, the other ecosystem players who can provide that to the investors in a better format. Large number of these investors won't spend time on reading the several hundred pages, and with the regulatory changes, those number of pages are only increasing. But then how do you really make sense of that numbers? How do you convert the numbers into the right narratives without losing the importance of the numbers? I think is very critical, and there could be an opportunity on that. And of course, improve cross-referencing, where information that is already included in one part of that annual report, in the notes to the financial statement, is not repeated without further analysis. In what context the same thing is appearing somewhere else? I think that's what the investors would be looking at. And their expectations from people who set the standards, whether the accounting standards or auditing standards or the disclosure standards, etc. Or in India, you have the listing obligations. If you're a listed company, then you have to present a lot of data and information to the investors. The development of a disclosure framework that allows management to decide what disclosures are relevant and necessary, rather than just keep adding pages after pages in a certain format. And also, how do we reduce the overall volume of the financial statement without losing the actual spirit or the actual sense that investors can make it. So this was the investors' expectations from the management, the way it is presented, and from the standard setter. So that's the investors' expectation. On the other side, for companies like us or all the other businesses, there's increased regulatory compliance, which is only increasing, and particularly since 2008, if you look at US, whether the Dodd-Frank or the Taylor rule and variety of other regulations, same thing in India. And it's a justifiable requirement, as I said, particularly post the global financial crisis. And it's not only increasing, the second derivatives is increasing at a staggering rate around the world. In last couple of years in India also, giving the example of the mutual fund industry, we have seen like a credit crisis in the economy. We saw a liquidity crisis around the COVID time. And as responding to that and to ensure that the system is foolproof going forward, we have seen large number of circulars from the market regulator, and then the people at our end in the compliance or people at the regulator's end have to keep pace with all of that. It creates a lot of complexity, and of course the stringent timelines within which we have to submit the information. And of course, so you have created a system for your compliance or for your risk management, etc. But how to make it more robust, that the newer circulars which are coming, and I'll give you a few examples with some test cases for you to work upon in case somebody is willing to. How do you modify that your core system? And maybe I can give that example of the recent circular on the pooling of account, that how several players in the system are finding it difficult to cope up with. But I think if we had invested, I think as an ecosystem on more robust system, then it could have been relatively easier. And of course, I think if you don't do it, then it's not only about the penalty that you get from the regulators, but also the reputational risk And of course, the impact on the business in the very long run, your ability to hire right talent, all of that gets impacted very, very severely. And that's why the importance of RegTech and the SupTech. And a lot of these legacy systems and the insufficient automation and digitization is not able to cope up with the regulatory changes that are coming. So if you put all of this together, on one side, you have high levels of regulatory compliance, which is only increasing in terms of complexity, in terms of stringent timelines, in terms of the way it has to be presented to the wider world, in terms of the way it has to be complied with, in terms of the way it has to be submitted to the regulator. On another side, you have investors who want better information, more timely, more relevant, material information in a format where your reporting format and the viewing format that they have to meet. We used to say, what you see is what you get. Here is like what you get is what you want to see is what is presented to you. How do you? And the third thing is, but with both of these, they add a lot of burden on you, right? I mean, if there's a lot of regulatory compliance that you have to deal with, the investors' expectations are also increasing. In fact, I didn't add the third part, and maybe I'll give one or two examples where a lot of work needs to be done in India as we evolve over the next few years on the RegTech and SupTech, that the rest of the ecosystem, I mean, let's say CSR is a large amount now by corporate India. It's not only your investors who are looking at your annual report, but let's say the CSR ecosystem is also looking at what is the spending, where that spending is going, what is the impact of that. So you need a lot more information. I'll talk about ESG a little bit, how investors are looking at that information, but there's a lot of work that needs to be done. Now with all of this, companies want lesser burden, right? Because otherwise, how many people you hire, how much investment you make, and how do you ensure that you don't make mistakes in terms of complying with the information. And that's where the technology solutions become very, very, very critical. As I said, increasing regulatory compliance, which is very complex with the stringent timelines. The investor expectations are increasing, expectations from other stakeholders are increasing. The only solution is you invest more in the technology over a period of time. And this is one area where relatively, compared to all the other areas in the fintech, lesser amount of investment has been made. I made a comment in the beginning that India has transformed from a data poor to a data rich society. We take huge pride the way India has adopted the data. And one of the important aspects is that particularly for the financial institutions like us, we look at a lot of structured data, but there is so much of unstructured data. I mean, we keep talking about it that we are adding more data every whatever. I don't remember that whether every minute or every hour or every day, which I think we wouldn't have done in the previous several years. But there's a lot more unstructured data, which is still not used as much for the insights. Now that you have the Aadhaar data, and of course the requirement of the localization of data storage, it requires strategic data management methods. Particularly if you are in compliance and risk management, you would be very particular about that. This is specifically I wanted to talk about when I said the rest of the ecosystem. So investors are looking at your financial statement, they are looking at your annual report, they are looking at all your other filings. But now there's a lot more data requirement by a lot of other participants, and over a period of time, this will become very important. You might be knowing that from this year onwards, companies would also be coming with something called BRSR, business sustainability and responsibility reporting. So it's not only about your business and financials data, but you'll have to give your data pertaining to the environment. So whether it's your carbon emission, whether it's your water usage, I mean renewable versus non-renewable energy, your waste management. I mean, if your products are degrading the soil or impacting the environment in any manner, the social statistics on your labor practices, on your community support, etc. And there, I think there's a lot more work that needs to be done. All of it is voluntary currently, but a lot of unstructured data, a lot of alternative data, I think needs to be used, and that's where I think there there are going to be a lot of opportunities on this. I give a classic example. I mean, if you are a large company and you say that, okay, we don't use child labor and you score higher, but what about the ecosystem? What about your vendors? If they are using child labor, then what? Because that won't be like, a company won't be disclosing that. How do you identify that? You might be disclosing about your carbon emission, but what about scope 1? What about scope 2? Over a period of time, there'll be a lot of opportunities because some of it will be available, some of it will be disclosed by the company, some of it will have to be taken from the various sources, and companies will have increasingly more and more responsibility to put data and information analytics on the ESG. This is just one example, but variety of other examples can be given. And as I said, that I mean, putting all of this data and analyzing will require huge computing power, as well as I said, that if you put across all the other regulatory needs in terms of data privacy, in terms of data leakage, in terms of localization of data, there would be a lot of opportunities for the technology providers. There will be a lot of policy initiatives. I think the previous speaker talked about it in various countries, what has happened. I think you must look at the overall TOR of the Market Data Advisory Committee in India. In fact, I have that as an annexure, and I'm sure over a period of time, a lot of interesting things that can come from this. So, I mean, as I said, that given the regulatory requirement, increasing regulatory requirement, increasing investors' expectation, increasing stakeholders' expectation, if technology can help us in end-to-end governance and the regulatory compliance, a lot more cost-effective, because through the digitization, through the cloud solutions, using the APIs, etc., creating those interfaces with various partners or various solutions, the real-time reporting and analysis, a lot of things which happen over a period of time are needed to be in real time. We have made a lot of progress. I'll give you some examples from our industry, how the timelines have got crunched, thanks to the technology that the industry and the ecosystem has adopted. For example, in our case, I mean, our NAVs are out by 11 p.m. every day. And then, of course, there are a large number of users of that data and various other information on a daily basis, which gets published on our website. Now, think about it. The large number of new transactions that are coming, people are putting redemptions, people are putting new subscriptions. And then on the other side, large number of transactions that are happening through the STP, they get settled, through the registrar and transfer agent, these get settled. And then in the evening, you are preparing an annual report, you are preparing a trial balance and the balance sheet and giving that NAV at the end of the day. And there are lots of other partners who are involved in that process. Somebody is giving the valuation of those securities, in equity that comes from stock exchange, in bond that comes from two of the rating agencies that have been assigned that job by the Association of Mutual Funds of India. There are so, I mean, to keep it very simple, with all of that in the evening, you come with that one NAV number, but there is huge amount of activity that is going behind that. And as I said, this is very important, that report making format, same as a report viewing format, the way investors want to view it and the way companies or the other people disclose it, it's very, very important. This is very critical, and I think COVID highlighted the importance of technology a lot more. And of course, I think no crisis should be allowed to go waste. And I think it clearly showed how we all adapted to the technology, or how we adapted to the new world. And I think it has given us an opportunity to think laterally what else can be done. Of course, the things are coming back to normalcy. The physical world is back, but we should not lose this opportunity that even if people were not in the office, I think our disclosures, our overall transparency standards, or the way we interact with the customers, and particularly the regulators, because for them, at the time of the crisis, the importance of getting live data actually goes up a lot more than what it would be in a normal world. So how to prepare for that crisis period, or how to prepare for that business continuity is very, very critical. Also, I think, I mean, I've talked about the cybersecurity, data leakage, and the data privacy. I'm not a technology person, But I think what I hear from my colleagues is that even in this area, where of course we are at a very early stage when it comes to the RegTech and the SupTech, we need to keep an eye on what's happening in the blockchain and what else that can be done. I'm sure in the previous session, you have heard a lot about what the SupTech is, what the RegTech is, what output is like. What over a period of time it can do is improve the oversight, improve the surveillance, and improve the analytical capabilities. It's not only about getting that data, but ensure that it becomes a lot more forward-looking, lot more judgment-based. I think the SEBI chairperson has been saying that less dogma, more data-driven decision-making, and that's where the importance of technology. And also, as I said, that compliance or the regulation or the risk management should not be looked at only from the reporting perspective, but a lot more into how the improved decision making can happen if you use the better technology. I'm sure a lot of you would be aware of like what have been some of the major demand drivers. It's about, I mean, large number of people have voted that is because of the enhancement in the efficiency and the effectiveness, as well as the improving insights that you get from the SupTech. And in case of the over a period of time, I think both for the SupTech as well as for the RegTech, the business productivity improves, the efficiency increases, you find newer ways of working, and of course, better risk surveillance and mitigation, so on and so forth. I mean, in fact, I've heard this from the CEO of one of the largest bank in the world that given the increased disclosure requirement, given the increased regulatory requirement, I mean, he mentioned it on a lighter as well as on a serious note that my headcount in the risk management and compliance is only going up, but I have to manage a business. So my headcount in other parts of the businesses have been going down. But that's not the right way in the long run, honestly. If you leverage the power of technology, and technologies have improved so much, logically you need to have more people on the other side and not as many people to kind of manage all of that. So you need people who are smart to use the technology and also, of course, have the right brain to take a holistic view of where the world is moving. So the amount of spending which is happening on this side over a period of time, I think if the technology is used, then it can come down. There's an interesting data that I don't remember which year it was said that I think post the 2008 global financial crisis that more number of pages have been added in the statute than what happened over the last several decades. That's the kind of requirement which has happened. Now, of course, I'll talk about a couple of the use cases. Of course, I think credit a lot more has been talked about. I think in next couple of days, you'll hear from a lot of people, particularly as we are a hugely underpenetrated market when it comes to credit. Credit as a percentage to GDP is a very, very low number in India. So I mean, you hear about BNPL, you hear about how in the corporate credit, where there has been very little amount of technology that has been used, but now you have lots of interesting solutions coming up. And particularly from the risk management and compliance perspective, as the number of regulations are increasing on that, for example, at our end, the number of regulation that has come in last few years in terms of stress testing, in terms of a variety of other, whether it's the swing pricing, stress testing, PRC, so many of those things that have come up, there is tremendous potential for the people to work on those aspects. I'm sure I've already highlighted enough about it. And also, as I said, that as more and more, I mean, you use the technology then, whether in terms of reporting, in terms of modeling, in terms of scenario analysis. And I always say this, that most of the people, and that's where the role of AI and ML, that most of our risk management comes from thinking very linearly. It's an Excel sheet where you just extrapolate things. So when we say we are stress testing, you just put, let's say, interest rate goes up by 100 basis point or comes down by 100 basis point, or liquidity changes, or let's say the rating changes from this particular bucket to this particular bucket. But the real risk come from unknown. Nobody would have predicted a geopolitical crisis that came in February and what happened in the nickel market in LME. Nobody would have predicted that the world will have a demand and supply shock of an unprecedented nature in the month of March 2020. Oil went to below zero. Now that's something which won't be there in any Excel sheet. And oil could, in a year's time, when it was below zero, nobody would have predicted then another 1.5 years period or 2 years period, we would be at 130, 40. So how do we really look at risk very differently? Of course, a lot of it would be the right brain and not the left brain analytics. But I think even there is a lot more work that needs to be done when we think about the scenario analysis and stress testing, and how do we take inputs from maybe other areas of physics, maybe, I mean, or the other areas from the other faculties to think about this very, very differently. I'm just throwing an idea. I don't have a concrete thing on that. On the compliance side, there are a lot of examples that I can give you from the mutual fund industry side. The interesting thing that people can do where we spend huge amount of time and energy. I'll give you a few examples. Like I talked about the stress testing that we do, or for example, we have something called a riskometer, where based on, let's say if you have an equity, then based on the market capitalization, based on the impact cost, based on volatility of a stock. And if it's a fixed income instrument, then based on the credit risk, based on interest rate risk, duration, and based on, I think, liquidity put together, you put like, you take the security score and the fund score in a particular. Based on that, now there are a lot of new things that have come, something called a PRC, a potential risk class, stress testing, swing pricing, I mean, putative, I mean, there are a variety of things that have come. Of course, solutions are emerging. But if I put myself in the shoes of somebody who's in compliance, a lot of these are front office solutions, may not be part of, let's say, a RegTech, but I see over a period of time as these things are increasing, complexity is increasing, newer instruments will come. So you have created this entire system. And now, let's say, based on, let's say, the kind of bonds and equities that you trade in, now suddenly, let's say, new instruments have come, a REIT or an InvIT or something like that, then how do you really, is the system robust enough to take care of that? You start investing offshore and you have added a new layer, which is a currency, then how is the system robust enough? But I give you another, and a couple of other things that we have done with the use of like our technology partners. I tell you interesting that all of us have to disclose any investments that we have made at a periodic, at a certain periodicity. So if I've invested in certain funds, then it have to be disclosed to the compliance team. Several years back, it used to be manual, then it was getting the online done, but still the compliance team had to follow with large number of employees, because it was employees who were giving those transactions, because it's only the employees who are aware of the transaction. Now, a small technology solution, and it took some time for the industry to get there, is that if you connect every employee's PAN number and you look at the R&T agents, let's say a CAMS or a K-Fintech, and attach with that, you get the direct feed from them. Or I think if let's say, an AMC is allowing transactions in the secondary market, or let's say an IPO, which, I mean, of course, you need to take prior approval. So right from the prior approval to the actual transaction reporting, etc., you attach that PAN number with the secondary market broker that the employee is using, and then the employee doesn't have to think about it. Of course, they would go into the system and sign it, but it saves a lot of time for the compliance team to follow up. It saves a lot of time for the employees to submit that. Otherwise, I remember several years back, there used to be a large file where there are individual transactions, and then, I mean, the compliance team or somebody in the other team putting that on an Excel sheet and trying to analyze that. It's just one example, and there are many others. A specific thing I will say that where I think we need to find some interesting solution using the new age technologies. So there is a call recording that happens of all the dealers, or let's say now the fund managers also, and the people in compliance or risk management regularly listen to those calls to see at what time the fund manager gave the trade, at what time it got recorded, at what time it was given to the brokers or to the market, what was the conversation during the day, what time they logged in, what time they logged out, so on and so forth. And I was just thinking, and they spend hours and hours and hours listening to the actual conversation that happened during the day of the entire conversation that happened in the dealing room, and now the fund managers also. And I was thinking that if you use the technology today of, let's say, speech recognition, the text analysis, and various other, as I said, I'm not a technology person, but put the artificial intelligence into it, where any kind of anomalies get thrown. You use the NLP once you've got the text, and any kind of anomaly gets thrown, which only then the compliance person or the risk management person has to pay attention to. And it saves, actually, I'm not exaggerating when I say hundreds of hours of the compliance time going into it in a year's time. I can give like several other examples like that. For example, on the market regulator are always concerned about, let's say, us as an asset manager or our channel partner, a distributor or an advisor, when they are selling a product to an investor, and how to ensure that the products which are sold, they are right, suitable product for that particular investor. Now, of course, we do a lot of work for investor awareness. We do a lot of work for distributor awareness. There is a lot of, some bit of like technology which is used by the R&T to look at, like, disaggregate or aggregate the transactions by the distributors and see some patterns, and if there is any hint of anything which doesn't meet the eye. But I think there is a lot more potential for the technology to do on that front. Maybe I could have given some other examples, but in the interest of time, there's a very specific thing that I want to talk about and throw a challenge. In the 90s, where most of our work used to be physical, I've worked on, like, in those days, like Lotus Notes and maybe some programs of Fox Pro, etc. Negroponte said this: if anything can be digitized, it will be digitized. And over the years, I've seen my industry getting transformed with the amount of information we put on a live basis and on a periodic basis is humongous, is absolutely humongous. The amount of public scrutiny that happens, the amount of media scrutiny that happens, the amount of regulatory scrutiny that happens, because we put so much of information in highly transparent and highly accessible and highly analyzable. I don't know whether that's a right word in English. In that manner on our website. Variety of these information are there. I'm sure there could be some opportunities where technology can play a role in making better sense of that and putting it in a more cohesive manner. You get so much of information on a daily or fortnightly or a weekly or a monthly, quarterly, half-yearly, annual basis from the industry, and of course the Association of Mutual Fund again put that. There are a variety of other things that we provide to the world, and maybe in a minute's time I'll come to that, a very specific case, but it is used by various other players. So, for example, we are supposed to put all our trades in fixed income within like 15 minutes on the system. As you know, equity market is like, of course, live on exchanges. You get the price minute to minute. In fixed income, a lot of market is over the counter. The transaction happen between the two counterparties, and in the wider world may not come to know about the trade that has happened, but the regulators have ensured that transparency increases. And what they have done is that there's a system called FTrack, where within 15 months of we entering into a transaction, we have to put that on the FTrack system. There is the bricks or something where on one money market transaction and on another platform, all the bond transactions have to be put on the system, so that the rest of the ecosystem can use those prices. So there's a parallel flow of information for the rest of the ecosystem to use that, which builds more investor confidence, which build stronger capital markets and economy. And there are a lot of opportunities to work with with everyone. I won't use this. I'm sure you are aware over the years how, I mean, there was this example about KYC in
Uh,
the previous.
Mr. Navneet,
Yes, just two
uh,
minutes. Yeah, go ahead.
apologies to interject you in between, but with the interest of time, I mean,
Just
I personally want to like learn more about this concept, and it has been like really engaging for me. But I mean, I have a couple of questions on the audience side.
Just
Do you want
1 minute
to take
I'll
that?
take on this. Just 1 minute that, we have this SID that we have to put.
Sure.
SIDs have lots of information. These are the contents. You can just Google and see any, let's say, RAMC SID, and we have like, I mean, several of them across all our products. And over a period of time, we have to update it every half yearly. There is a separate SID for each of the scheme. For large MFs like us, we'll have more than 50 SID, and we have to update this data regarding the scheme and benchmark, regarding all the regulatory changes that have happened, regarding some of the voluntary changes by the fund house, if you have changed the exit load or fund manager, the services, if we have changed, like any kind of what kind of SIP facilities there, any pending litigation that has got filed during that period, comparison with our existing schemes, AUM, folios, if a fund manager has changed, so on and so forth. And I think there is an approach, and a lot of compliance time goes in this, because you want to be 100%, 110% sure that whatever you are updating is absolutely live and current, and the content is also accessible in the right format to the end investor while complying with the regulation. There's a huge opportunity if somebody in the RegTech can come with a solution, look at this entire SID, look at our process, and come with a way that a large part of it can get automated. Then you are a lot more sure about the accuracy, and you save huge cost in terms of the time that goes. So over a period of time, this could be a very interesting opportunity. I thought I'll throw to you. I mean, the chairperson has mentioned that if there is a very specific case in the RegTech where you can help, and we'll be very happy to work with anybody who comes forward to help us on that. With that, we'll be happy to take any questions.
Great. Thank you so much, Mr. Navneet, and it was really an interesting and session where like we focused on multiple aspects of this topic. But I think like I have a bunch of questions on the audience side, but I want to take one interesting one is which is more on a personal side itself for you. So if you can tell a brief story in terms of how you ended up becoming the CEO of the HDFC AMC. I think like the audience members actually wants to know a bit more about your background and how you rose up to the position.
I came from a small town in Rajasthan, a place called Byawar. I mean, I did my CA, and luck had it that I got rank, and it was 50th rank. So the C Institute only gives merit to the 50 people, and I got 50th. Had there been 1 mark less, I mean, the life would have been very different, and ended up in financial services. We were very lucky to get into financial services in early 90s. That's why at a very early age, became a fund manager, became a CIO, became a CEO. I think if you have heard, if you have read that Outliers book by Malcolm Gladwell, that's applicable to a lot of us who entered financial services in early 90s, and applicable to a lot of people in technology who are entering now, when the confluence of factors are leading to a more technological usage in every sphere, particularly in the finance. So over the years, I would say, I mean, if I have to say that success maybe at early age, how I ended up here, I think it's a deep sense of purpose, and I really mean it. I always believe that a deep sense of purpose, that making money for other people, creating wealth for other people, meeting the financial needs of other people is a very noble job. And I think I was very, very fortunate to be part of this industry, and always keeping that purpose at the heart of everything that I do every day has led me to be where I am today.
That's really fascinating story, and it's really great to know about it. I have time. I have a couple of other questions as well, but I'll take only one. It is from Mr. Rakesh, and the Rakesh asks that how does the system ensure that audits are trustworthy?
You are absolutely right, because I think the way I did audit in my articleship days and the way audit is done today have undergone a massive change. I mean, earlier when you were looking at the voucher and you were looking at at a bookkeeping system, which became like, let's say, some of the I would say IT packages to an ERP, to a different world today, where there are like multiple systems, etc. So of course we have to trust a lot more on technology, but that has also made it, I would say, an easier. I mean, I don't know whether easier is the right way, or maybe I would say a robust way of like auditing, because you can do variety of the cross-referencing, you can analyze the data, you can interpret the data a lot faster using the computing power and using the technology. Over the years, I think accounting standards and auditing standards have improved very, very significantly in India. I don't have a doubt in my mind when I say this, and I say this with I would say full, I would say, confidence that I think in India they are far higher than a lot of other places in the world. What happens is that at times maybe there is a small, I would say, a proportion of industry, or that will be there in any ecosystem, which is probably not I would say adhering to that. But otherwise, the overall, I think auditing, accounting standards have improved very, very, very significantly over the years, thanks to the technology, thanks to regulation, thanks to the increase in computing power, even with the stringent timelines on the largest market cap company in India would announce results, quarterly results, I think on Monday, 10th or 11th, in like 10 or 11 days, which would have been unthinkable a few years back.
Absolutely, absolutely. And it's quite fascinating that what sort of a digital transformation within every segment, which we have seen in past couple of years, and like regulators have always kept pace with that as well. With that, I think I do have a couple of other questions which I would love to take them, but
can I
with
just a minute? Can I ask one question? Hi, Navneet, actually. So this was very interesting to know that the SIDs that you do for each of the AMCs is available, actually. So in the interest of the various technology developers who would have logged in, actually, let me ask you a question. Is this publicly available? And
yes. You go to our website, you'll get the SID. You know what is the content, and we'll be very happy to work with. I can assign people in my compliance and risk management team and the other teams if somebody wants to come and have a chat with them and explore. But not that, I mean, we do it in a timely manner. We are doing it highly efficiently. Industry is doing it, but there could be opportunity, and it's not only about just automating that SID, but variety of other things that will happen to work on RegTech once you do that. Because in SID, I'm putting so much of our internal information that I'm sure the eyes will get opened up what more potential that can be there in the RegTech. That's why I put that specific test case for everybody to work on, for some people to work on.
Thanks,
Great. Thanks a lot. And with that, I would like to move ahead with the agenda and move I would like to thank Mr. Navneet for joining us today. Feel free to stay around, and we can take any other questions towards the end when if we have some time left. And you can answer the questions on the chat window as well at the bottom. With that, I will move ahead with the agenda and welcome Mr. Naveen Mathur, Director of Commodities and Currencies at Anand, Rathi, and Mr. Dr. V. Shunmugam, who is the Head of Commodities Cell at NISM. And the overall agenda for the next Fireside Chat is making commodity markets understandable to investors. Over to you, gentlemen.
Thank you very much, SEBI, the people in SEBI, and I would like to thank Navneet for kickstarting our thought process of what we need to say on the commodities and currency, both of us, myself and Dr. Shunmugam. So Navneet, it was a pleasure hearing you for the last 10-15 minutes, and I think we will do our justice to take this discussion forward in terms of whatever best we can do for fulfilling the need of understanding the commodity derivative markets or the commodity markets in general on this session. So very much thankful to the entire SEBI team, the panelists, the other co-panelists who are part of this particular Ideathon, or I would say the Manthan event, which is well recognized, I think, in the social media till date. So thank you very much for inviting us. I would say that I would like to say a few words before we start. So I would like to invite a senior colleague of mine, Dr. Shunmugam, to share his perspective, a brief introduction and share his perspective. So what we have thought about in this entire session of 40 minutes is that we would briefly share a kind of an introduction on the commodity markets, which would be shared by both of us. Both of us means Dr. Shunmugam and myself, and the journey till date since inception of the commodity markets in India, and where do we stand today. So since it is 40 minutes, so we'll not take more than 6-7 minutes on having the introduction on the commodity derivative markets or the commodity markets in general. And post that, we'll have, since it's a fireside chat discussion, honestly, let's be little, I would say, interactive on these discussions, and we have developed some 5 questions between 2 of us. So a few would be answered or responded by me, and few would be by Dr. Shunmugam. And then maybe for last 5-10 minutes, we can have a question answer session from the audience. So I would like to invite, as a panelist, both of us being panelists, but I would like to invite Dr. Shunmugam to share a certain perspective on the commodity markets, and once he is through, I'll share certain things on the commodities too, whatever I have felt. So a brief background of mine: I'm part of this Anand Rathi group for the last 4 years. I'm the director on Commodities and Currencies. I take care beyond commodities, some international activities, and I'm looking after the organization's initiative on the Gift City IFSC. So that's my brief profile. So before joining Anand Rathi, I was part of MCX, the Multi-Commodity Exchange of India, spent around 2 years. And prior to that, I was part of Angel One, which was angel broking at that time, from 2007 to 2016. So part of the commodities since 2004 in financial markets for the last 27 years. So with that note, I hand over my mic to Dr. Shunmugam to share his credentials. Everybody knows him in the commodity market, so no need of much of introduction. But since it's a new kind of a structure altogether, the introduction, and then maybe introduction on the commodities. So Dr. Shunmugam, for you, sir. Thank you.
Thank you, Mr. Naveen. Thanks for the quite nice introduction. So happy and pleasure to be there, and thanks a lot for SEBI for providing me the opportunity, and also the National Institute of Securities Market the opportunity to represent the institute in SEBI's this initiative, the excellent initiative of Ideathon. So as Mr. Naveen had said that, so we will be going through those questions which we have felt that would be wonderful in terms of your knowledge and your understanding about commodity markets, and kind of excite you to put in some more questions on, what do you want to know more from us, actually. So having said that, let me give a brief introduction of myself. I've been introduced by the moderator himself that I'm heading the Commodities Education Cell at National Institute of Securities Market, and prior to NISM, I was with the Multi-Commodity Exchange of India, and privileged to be colleague of Naveen Mathur for 2 years, and I've been there for about 4 years as head of research and index administration, actually. So that's in brief about my profile, and without much ado, let me pass on the mic to my colleague, Mr. Naveen, to introduce us into the world of commodities, actually, and post that, let me come back and fill up the gaps which he would have left on, and then we will take into our question and answer board. Thank you, Mr. Naveen. Please go ahead.
Thank you very much, Dr. Sir. Thank you. It's always been a pleasure to be part of the panel discussion with you. We have shared numerous forums, and so as I mentioned earlier, so I'll start with a kind of an introduction. We won't take, since it's a devoted time, I'm keeping my watch in front of me to make it and to ensure that we don't overrun. So we are starting the session at 12:10 We are at 12:15, so our time limit is till 12:50. So with that particular thought, we'll start with the introduction on the commodities. We were there in the inauguration session of this Ideathon event last week. And what the chairperson said on the SEBI chairperson said was on a couple of things: the latest developments, the financial inclusion, the regulatory, the technology, the changes in those aspects. So we'll try to cover a couple of things through these question answers posing to each other, and then maybe the 10 minutes last on the questions and answer session by the audience. So I'll tell you briefly. So Indian markets on the commodities are not new, although we have come to understand that there are some exchanges which have come up in 2003. But if you really ask us, the commodity markets in India have an origin and they date back to year 1893 when the Bombay Cotton Exchange was established. So we are, I would say, more than a century and a quarter to this particular markets. There have been too much of ups and downs on the commodity space. So 1893 was the establishment of the Bombay Cotton Exchange. We have the Gujarat Vyapari Mandal, which went into the commodity markets in 1900. We have the interesting development in 1920s when the commencement of futures trading were allowed. I won't say by the government, but the people who were running the show in India at that time, 1920, mind you, the commencement of futures in futures trading in gold and silver. There were establishment of the Bombay Commodity Exchange again in 1938. There were a couple of bans on cotton derivatives. After the World War II, there were certain restrictions which came up onto the derivatives market, and therefore the commodity derivative markets were having problems in 1930s, 1940s, and I would say till 1970s and 1980s. Means there was suspension, there were prohibition of forward trading in oilseeds in 1943-64. We have the raw jute, where the suspension of the futures trading happened. So not many things happened in 1999. We have the futures trading permission again starting off with the edible oil complex. So there were not many things which have gone in from commodities since 1893 till date. Coming back to the recent times, means in 1999, the first thing, good thing happened by the government at that particular point of time was the permission of the futures trading. And by futures trading, what I'm trying to say, futures and options are part of the derivatives market. So futures trading was allowed in the edible oil seed complex. There were futures trading in 2001, which was allowed in sugar. And then in 2003, a drastic change in the regime of commodity markets happened. And that regime change was the launch of national-wide or national level commodity exchanges, which offered products in derivatives, and derivatives are futures and options. So 2003, the government through the Gazette sometime in April allowed the permission to start the national level exchanges in commodity. So commodity derivatives came up. We have the birth of 4 exchanges. I won't say 4, predominantly 3. There was MCX, which fortunately both of us have worked together. We have the NCDEX, which was again launched in 2004. And then we had the other exchanges like I think the Ahmedabad-based exchange and
National Multi-Commodity.
National Multi NMCE. I'm sorry to figuring out the name, and National Multi-Commodity Exchange, and then based out of Ahmedabad, and then we had the National Board of Trade, which was used to be kind of more on the edible oil soya complex. So these were the 4 exchanges which came into the limelight. When we started with a note that all these commodity derivatives exchanges would fulfill the requirement of price risk management. The derivative markets, as we know, function and give 2 things. One is the price risk management, and they discover the price efficiency through the price management. So there is a price risk management which is served by the derivatives market, and there is the price efficiency efficiency, the discovery of prices, the right prices, the price efficiency would serve the purpose. So that's what the intention was. As we all know, our commodity markets, be it agri, just don't relate to agri, be it agri or be it international or non-agri space, are still opaque. Means we had gold, but then there are jewelers, means right across every nook and corner, what they were charging, on what basis they are pricing their product, they're giving you the jewelry at what product. So this entire market has been not been too much transparent. I would say it was too much opaque. So with the intention of the government to get into with this price mechanism, the efficient price mechanism on the derivatives, the thought is good. The thought was good at that particular point of time. Then, but we went through with a couple of challenges in spite of that the commodity derivatives were launched on these national level exchanges, and they were recognized exchanges. They were governed by a regulator, Forward Market Commission. Although the Forward Market Commission in 2004 was not a regulator with autonomy, so it was part of the ministry, it was part of the department, and that particular department was regulating through FMC till 2015. A sea change has happened in 2015 when the things changed. The FMC got merged with SEBI. The SEBI, our regulator, the creator of this Ideathon, and therefore the SEBI came into the picture for regulating these commodity derivative markets. And by virtue of coming in SEBI as an autonomous regulator, since 2015, there are many changes which have happened in India for the commodity derivatives. So I would like Dr. Shunmugam to share what have been the recent developments. But yes, the commodity markets, even today, I'm not saying that the derivatives coming up, but still we are opaque. The agricultural market lack transparency. The governments during the course of time have tried to ensure some kind of, I would say, the technology-oriented advances towards agricultural markets. ENAM is one of the cases. I would say the Safal project in Bangalore some 10, 15 years earlier was the other initiative, where the government intentions are or would continue to be that these markets, in spite of being opaque, but can they be better organized? They can be better transparency come in. So there are logistics issues, warehousing issues, the lack of data, and because of the lack of data, the production, the decision for commodities to be sold or to be harvested, somehow difficult. So there are a couple of things which have changed of late, and I think largely, as the chairperson of SEBI the other day also said, a play of technology, and I think the technology would continue to play a big role. The financial inclusion, the banking, the technology, Sabka Vikas, Sabka Saath kind of initiatives would help definitely for the agricultural sector or even the non-agricultural sector on the commodity space to be little vibrant. So with that thought, I would like Dr. Shunmugam to say a few words, and then we go into a question answer session with both of us and our views on those questions. Dr. Shunmugam, to you now, sir. So I've taken 5 minutes of allotted time of mine, sir.
Okay. Thank you, Mr. Naveen. Perfect. I mean, you've given the right perspective to the launch of the commodity derivative market, and you'd also taken us, in terms of saying that it is as old as the stock exchanges in the country is. Actually, some of the people, when I go and talk to, they don't believe in this statement that the commodity derivative markets are as old as these stock exchanges in this country is, because they always think that the Bombay Stock Exchange is the first organized trading place for a financial instrument in the country, actually. So maybe so that let me take that. So the understanding problem is, like, why did it come at that particular point in time? So 1875, wherein this unorganized way of trading the forward contract started, and the Bombay Cotton Exchange, as Mr. Naveen said, started up its operations in 1890. is that like, the Britishers, when they were ruling us, actually, so 1875 was the year there was this, there was this revolution that was happening in the US, where US was one of the, British colonies, actually, where they used to procure cotton out of Georgia, ship out to Manchester, spin them, and then like send out the, the cloths over to the rest of the world, actually. So they couldn't have their supplies from, say, Georgia in the US, actually. So they started looking increasingly at the supplies which were, coming in from India, actually. And having said that, so they were at their peak in terms of their ruling in India, and they said, like, why don't we looking at India as one of the source of supplies? But sorry, we don't have a way by which we can manage the risk. Why to manage the risk? Basically, because when they ship out the cotton from the Mumbai port into Manchester, so it took around 2.5 months, and then after that, it took about a month or month and a half to basically spin it into cloths, and then another 2 to 3 months to ship out to their destinations, and then finally realize the value. By the time the value of the cloths came to me, it may be different compared with the price of the raw material. So they wanted to lock in the prices of cotton. And so that's where cotton as a commodity took the prime stage in terms of getting launched in the forward market. So these are forward markets. And having said that, these forward contracts were largely traded between the physical players, but slowly and slowly, now it got launched into the futures market, where the instruments which are getting traded are futures, and these are financial instruments, and they can be squared off without even delivering the commodity or taking the delivery of the commodity. So that's the transformation Mr. Naveen took us through this period. So essentially, if you think about it, the development of the markets in the US or development of the markets in anywhere, it was the information and communication technology. The first ever information communication technology which started driving markets is the telegram. So the telegram that used to go by way of strips of papers. Actually, it's not the full A4 size paper. It's a strip of paper where the telegram gets printed out. And in that printed paper, the prices gets printed up, sent to the brokers. The brokers receive their prices on the telegram mechanism in itself, actually. And then they printed it out to the exchanges in terms of like, this is the price that I would want to. So the exchanges started, the trading on those, floors or whatever that you may call it, actually. So all of what was done by the exchanges at that particular point in time are all manual. And the exchanges which Mr. Naveen talked to you between 1890 and 2003 were all floors in which there were players from each side shouting at each other, saying that this is my buying price, this is my selling price. And there was a record clerk who was like, recording all of them, matching them and things like that. So the Martin exchanges, which came into 2003, resolved all of this by one way, that you can use your internet network, which is pretty much developed, and information communication technology, where we've been leader providing solutions across the world. We leveraged it at the right point in time to come at solutions which actually provided the exchanges as they are sitting there, actually. And the exchanges were at that point in time, as Mr. Naveen was mentioning, were regulated by Forward Markets Commission, and the regulation of exchanges went into the hands of Securities and Exchange Board of India in 2015. And since then, there has been a lot of changes that have been happening. Maybe we will discuss it as part of the question and answer session. What are the things that had happened over a period in time, which made it more accessible to the investors, actually? Thank you, Mr. Naveen. Please take it forward.
Thank you very much, Dr. Saab. Thank you very much. You actually took exactly 5 minutes in giving your response to the introduction. I would say that I know that people out here would have understood how the equity markets have worked. There was an outcry system when I joined in '94. One of the Delhi firms, arbitrage, one of the largest arbitrage firms. We used to have the teleprompters. So dealers used to be my people. Which was not computer, so they used to punch buy 100 Reliance to Calcutta teleprompter. The Calcutta teleprompter guy used to tell the person there was no mobile, nothing, no technology. They used to go to the pit, bid up or sell up, bid and ask quotes to be given, and then accordingly the trade used to be. So one trade used to take approximately 10 to 15 minutes from the moment it was given to the person on the teleprompter and the confirmation coming back. It is not the question of 10 to 15 minutes, it's microseconds with BSE technology. It is microseconds. So the things have changed. The technology has played a critical role in our capital markets. And I would say that the commodity markets are not far away, where the technology definitely would play a big role with the financial inclusion and the kind of a digital initiatives the government has been taking. So with that thought, we close up our introduction session on the commodity. It was a fast session because of the time constraints, then because of the 40 minutes allocated, and we have the 5 questions available with us. So I won't waste much of the time, Dr. Shunmugam. The audience out here is a little concerned with the commodity prices going up. Of late, and even the last policy meeting of the RBI this week, yesterday itself, the concerns on the inflation has been on the highs. And largely every newspaper or every media everywhere in the world, the government or the central bankers are talking about the commodity prices, and therefore the inflationary expectations on a different level altogether. So the accommodative stance has changed to normalization, or I would say tightening the monetary policy, and that has happened largely has happened because of the liquidity flush by the governments and the central bankers across the world, because of the COVID and the pro-growth measures the government and the central bankers have took. But at the same time, apart from the liquidity, the last 2 or 3 months of ours have been kind of Russia and Ukraine all through. And I think there's too much of the story on crude energy, etc., etc. So people out here know about everything on the Russia and Ukraine, the hue and cry, therefore, on the commodities prices, and particularly the energy. So my first question to you, and an interesting answer to be sought by the participants, is that what kind of an impact do you see? Means we have seen the impact. So what kind of an impact would be the case of the Russia-Ukraine? And B, on the commodity prices or the commodity markets, and therefore the broad policy making in terms of the interest rates, etc. So how do you see this, and particularly with respect to the contribution of commodities by these two countries and the kind of an effect which will going to come because of this crisis, the geopolitical crisis? How do you perceive, and what's your thought, and what do you like people to understand from this crisis, particularly with respect to the game play out on the commodities? Energy, we all know, $140. The crude prices have been all-time high at $147 in 2008 July. If I remember it correctly, it was shy away to be all-time high, but we managed to come back from 140. So I leave it to you to answer it in 5 minutes again, sir, and then maybe we'll take up the next question from that on. So thank you very much.
Thank you. Thanks a lot. Actually, so you rightly introduced that, so we went into a pandemic in 2020, and 2020 is the year where we saw, as Mr. Navneet had rightly indicated, negative prices of commodity. I mean, nobody ever in the real world would have actually understood what a negative price could be, which has been happening in the interest rate market. Not that negative prices are not there for any of the commodities or any of the services. That has been there in the Western markets, especially in the Western debt markets, where the interest rates were at a negative rate, and people were trading even the negative rates also, actually. So when all of a sudden this shifted over to the commodity markets, people were dumbfolded as to how to trade a negative priced market, actually. So that's one side of it. And From there, the crude rebounded, and not only crude, the entire commodities sector rebounded as we saw the world recovering from COVID in July, August 2021, and the demand all of a sudden boomed up actually. So as a result, the commodities started rallying. As you rightly said, the commodities have started rallying, and nobody ever thought that this could happen at the end of the day when Russia attacks Ukraine. Mind it, Russia and Ukraine are two large players in commodities, actually. So be it the agriculture commodities, be it the energy commodities, be it the metals, several of the crucial supplies are locked between these two countries. And interestingly, you know what? So I was just reading through one of the articles about what's that which is going on. One of the mundane, stocks, which is commodity, which is neon, which is also traded in the spot markets, actually. Russia and Ukraine between themselves are large suppliers of neon. And where is neon important? Neon is important in the laser industry. And where is laser used? A lot of the chips which goes into our laptops, into our computers, into our mobile phones, into our automobiles, into our electronic other gadgetries, the washing machines and things like that, televisions, all of this are being printed using laser, and that laser needs neon, and that neon supply is brought down to zero. So this is an instrument or a commodity which is not there in the spot market. We don't know how it is getting traded. Let's forget about it. But we do know how wheat is getting traded. We do know how the sunflower oil is getting traded, and we do know that how crude oil or the natural gas is getting traded. So the prices shot up off the roof as the financial part of the transaction have almost come to a standstill in terms of I can still buy, and Russia can still dare to ship the goods out to the countries where it wants to ship out to, but I cannot pay it to them unless there is a way that I can pay it to them. So that brought the commodity transfers between Russia and Ukraine into a standstill. Ukraine not because of the ban, Ukraine more because of the physical stoppages that have happened between the ports in Black Sea, which are the important ports from where the commodities from Ukraine have been shifted, have almost come to a standstill, actually. So because of the conflict that has been happening. Mind it, S&P GSCI, the Goldman Sachs Commodity Index, which has been one of the prime index having prices of all commodities from livestock to precious metals, in the last one quarter, clocked 29% returns, actually the largest since 1990. So that's the kind of return that was generated in the commodities, the entire commodities world. I mean, nobody ever believed that it will be of such a magnitude, actually. The WTI climbed up 33%, well above $100 per barrel mark, actually. So no wonder the stock prices of energy companies outperformed not only the S&P 500 index, which is the stock index actually, but also the S&P GSCI, the commodity index actually. So the prices of oil firms, the stock prices of oil firms shot up actually. The upstream companies exploring oil and mining metals witnessed a big jump in their prices in global markets following commodity prices actually. The wheat prices gained about 31% until the quarter end, the highest level since 2010. So that's about the food commodity actually. Thanks to India shipping wheat into the rest of the countries where we had the opportunity of being bounty on the one side, people started looking at India as a supplier of the commodities actually. So are the metals whose supply is dependent on exports from the region, which includes aluminum, nickel, copper, palladium, platinum. All of these entered into a new heights actually. So was inflation. Sorry, Mr. Naveen.
1 minute, sir, for you on this question. We have 4 minutes to go. 4 questions to go, sir. So I'm breaking you in.
Yes. So the prices of all these commodities, entered into a higher side, and as a result, obviously the inflation started clocking up. And the inflation in the German Bund market, which used to be on the negative side, actually, is today at 7.6% or 7.9% in the US actually. So that's the kind of inflation the central banks are facing today, as you had rightly indicated. That's the kind of inflation that the central banks had indicated actually. So will this rally cease as Russia and Ukraine announced the ceasefire? No, it has been famously said commodities are hot right now, but they are volatile. We don't know when they run out of the gas. So probably maybe we may have to wait for a long period in time before we could think about the commodity prices coming down. On the regulatory side, as Mr. Navneet in his previous session had rightly indicated, crude oil and nickel taught us two big lessons in terms of how not to regulate the markets actually. And the regulators across the world are learning what they have missed on in terms of what to do to control the prices in a better way. So there is a trade risk, there is a price risk, there is a logistics risk, there is a production risk because Ukraine cannot produce what it wanted to produce. There is this humanitarian risk, there is the energy risk, the exchange rate risk, and the economic growth risk. So we need to wade through all these risks in order to put us into economic stability and growth further forward. Thank you, Mr. Naveen. You can go ahead. Sorry.
Thank you very much, sir. Just to add on, sir, thank you for it. 40% of the Europe consumption or the energy is coming from Russia. So means we can understand how we are dependent upon Russia being second largest or third largest in terms of production of energy. The entire industry knows that. And that would be a key thing to look out for. And inflation is a byproduct of energy products and therefore the inflationary concerns. So we are keeping our fingers crossed of how the central bankers across the world will take their stance from the accommodative policy to tightening of the policy. That's the end of the first question, sir. I have some Ghanti here with me. So if the questions go out of 1 minute or 5 minutes of chat, I will ring this as they normally used to do earlier. When we used to have the conferences, the guy used to be in the lunch around that particular ballroom outside lunch to give an answer that was high time, go back to your workstation. So I'll have this Ghanti with me, which I'll run across. So just an idea, sir. The second question is, I think you need to pose to me on something.
So that was my question actually. So you are from the intermediary side, right? So you're from the intermediary side actually. Despite of the 2 decades of its existence, neither the research community in commodities amongst the intermediaries nor the recent technological interventions seem to have added any value to the commodity market participants actually. Be it a retail participant, be it a corporate participant actually. So they all, like say for example, if anybody wants to benchmark metal prices, anybody wants to benchmark crude oil prices, everybody wants to look at the prices of the Barclays forecast, the Standard Chartered Bank, analysis of the metal prices or whatever it is actually. So none of us had gone to that level actually. So where do you think from an intermediation perspective, we should take efforts in terms of making wider participation?
Interesting question, Dr. Shunmugam. I think I won't take much of the time on it, although it's a very interesting and very wide, diverse answer. In the global world, actually, we know that it is the commercials, and by commercial, the institution and the people who are, by definition of commercial, which is contributing 70-80% of the volumes in the international or developed markets. Here in India, the commercials, by virtue of definition, institution, corporate who have the physical exposure are not there. So they are kind of 10 to 15%, 5 to 10% sometimes on the space. Crude, nickel, whatever has happened has deterred people to come onto the platform. The agri commodities in India have been kind of whims and fancies throughout since launch. So therefore, being a largest producer consumption of various agricultural commodities, Dr. Shunmugam, the players on the sideline because of the government policies, so and so forth. The kind of, we used to say agri markets, but at the same time today, non-agri markets like crude and nickel also have been like that. The LME closed down the nickel contracts for some time and relaunched it again. So having said that, the intermediation, I've been part of the broking industry as for last 27 years, except for 2 years when I was with MCX Exchange. I've seen much of change. As I said, people used to run, put orders. Today, we are on the fingertips is at the mercy of our mobile. So a great thing has happened in terms of the retail per se. On commodity side, there has been certain challenges. The farmer liquidity contracts have not been part of great stuff. We haven't got liquidity. The commercials therefore have not come. The markets still are traders. The markets still are the speculators who are taking views on the markets in spite of all the reforms by SEBI has happened, but still a long way to go. So the intermediation in terms of people have changed drastically. I would say people have realized in the broking space, people have realized how the digital play would help people to participate. And to participate in commodity derivative market is one of the things which needs to be seen from a perspective of the diversification of your asset classes. Now, if you see in 2008, 2009, when we had the great recession because of the subprime in the US, we have the great problems in the Eurozone, the gold prices touched all-time highs at that particular point of time to 2075. We have seen COVID, the prices touched all-time high of around $2,085 or 56,000 in Indian markets for gold. So there's much has changed. So I would say the people have started understanding the benefits of diversification, the benefits of various products, various asset classes, and that's how the intermediation from us has also changed. So we are teaching people, we are telling them that what are the benefits of being into every asset class, also commodities, therefore, and how the losses or the price losses on the equity. See, the COVID times in early March, when the markets were totally uncertain on the equity, we have seen Nifty and kind of Sensex levels not to be seen, and we never thought about it. But at the same time, if somebody had the portfolio in gold, the gold prices was marching on the upside trajectory. So we are talking about education. We are doing much on social media as far as the intermediation goes. Much of thing through social media is awareness and education, through digital, through social media, digital channels, and we are seeing people are not coming to branches now. They are doing it on their mobiles. So the technology has helped through disseminating information, making people understand. So participation of new players by virtue of the reforms undertaken by SEBI has been a boon. Means we are seeing mutual funds. Navneet would have been here. He would have loved to listen to it, that the mutual funds, 5 of the mutual funds are empaneled with us who are trading on commodity derivatives because it's part of the portfolio on the multi-asset side. So it's much has happened, options, futures, reforms in terms of PMS, reforms in terms of FPIs coming up onto the market. So all that has helped a lot. And I think the intermediation would surely take some time to realize the benefits. But then as an intermediaries between us, I think we are seeing a drastic change of when we started journey in the commodity space and where we are today. So that's my answer to the question of intermediation and the changes which we are witnessing. So with that answer, sir, I'll put the question back to you. That means fire kind of chat. So it means I'm putting a little fiery question on you. There has been some talk on 2017 union budget that the government is having some kind of an interest to develop the spot and the derivative markets, the kind of building up the integration, and therefore the opaqueness of the market to become a little less because of the spot. See, the derivative markets are underlying spot, and if the stock markets are inefficient, the derivative markets cannot flourish. They cannot fulfill the requirements or the reasons of being there. So there has been a good talk in the budget in 2017 where they thought about integrating the spot and the derivative markets. What's your view on that, and where do we stand? Is it just the talk, or is that something has happened? If the spot markets are integrated, well integrated into the derivative markets, I think our derivative markets would be much better and would be comparable to what the international markets and commodities have been. And rightly so, we compare equity to equity in international markets versus Indian markets. So here is the case. And I think with respect to this intermediation, I would say that the equity markets came up after the cash segment. So cash segment was running. You have the spot markets, and then the derivative markets came up. Here in commodities, we have the opposite. We have the derivatives first launched, and the commodity spot markets are still opaque. So what's your say for 3-4 minutes on this topic?
So I'll take just 2 minutes actually. So the commodity markets are for price discovery and price risk management. And when we say about price discovery, the price discovery will not be relevant if we don't have delivery at the back of it. And if we don't have delivery at the back of it, the trust of the market may not be there. So one thing which SEBI did after the takeover of the commodity derivative market is, wherever the deliveries are possible, let's make the commodities deliverable. The metals became deliverable. Some of the other commodities which never saw deliveries happening are getting delivered over there. So over a period in time, when we see this, regulations around the energy products also getting, liberalized, we will see the energy products also getting, deliverable. Actually, that's one, which is from SEBI mandating all the derivative contracts to be delivered. On the spot market side, as you rightly said in the introduction, the government of India had, introduced ENAM. ENAM stands for price discovery for a particular quality, actually. So when you talk about a commodity derivative price, it's a price of a particular quality at a particular market. It's not for the entire commodity, for the entire country, actually. It's for that particular market, it's for that particular quality, actually. So having said that, ENAM is going to throw that transparency into the market as it grows. In addition to that, a lot of private initiatives that are currently vibrant in the electronic agriculture market space. This is NEML, NCTX Electronic Markets Limited, the BEAM of Bombay Stock Exchange, and NKrishi, and what else and whatnot. So many platforms have come up, which is going to throw a much of light on agricultural markets, actually. So on the energy side, now actually the market is going to evolve in the right way. That's what I would call it when, when you must have read about the launch of electricity derivative market. Having said that, the spot markets have developed well. So now is the time for the regulators to look at, should we look at launching electricity derivatives, actually. So in addition to that, the gas is getting traded in the spot markets, actually. So a lot of spot markets are coming up. They'll throw a lot of opportunities in terms of beating that opacity, which we have been always complaining about, and a lot of opportunities for the prices to get streamlined with the spot markets so that there is integration of the spot markets. So having said that, let me ask you the other question, actually. Despite various measures taken by the regulatory agencies, the policy changes have been brought about, the real users, in order to make the real users, which are the corporates, if you go to a jeweler, then he will say that I'm actually hedging my prices using the futures market price in gold, actually. So that I'm not able to see that, actually. So as an intermediary, which you are representing, what are the measures that you are taking in terms of making the marketable, usable by the intermediaries? I think you are muted.
So, sir, that's a very good question. As I said, the intermediation with respect to the commercials or the physical value chain participants on the commodities, and India being one of the largest on various fronts on commodities, we have not seen the things happening that way. Means although the intentions were good, but we haven't seen it reflecting into terms of people participating. So what we are doing, see, there are two, I would say what we are doing is that we are doing various initiatives in terms of making people aware. We are working on with exchanges along with our teams across country to provide education and awareness about the commodity derivatives and the benefits on the price risk management, particularly in the times of volatility. And I think the volatility will gonna continue with the changed world after COVID. So there are a lot many things which have changed in 2008. There are a lot many things which have changed after 2010 and 11 when the Euro crisis happens. There are a lot many things which have changed after Middle East, and a lot many things have changed with Russia, Ukraine, and COVID. So I think the volatility would be the norm. We are seeing volatility every single day. It cannot be a very smooth days all the days throughout. So volatility would help people to realize what can be the derivatives support to manage their price risk management. So we are doing educational seminars within our teams internally, providing education. Even in fact, we are doing educational programs. Although till now we were virtual for last 2 years, but we have gone out in small group forums, calling upon the SMEs, the worlds of small people who can understand the benefit of using the derivatives on the price risk management. So I think a lot much of effort has gone into, and I would like to thank the regulator on that aspect. We can thank the exchanges too, including your academic fraternities, that you are helping us to create education and awareness of ensuring that how the corporates or the value chain participants, physical people, can use these markets in times of volatility. So we are doing largely on the education. We are making short videos. We have made short videos which we are promoting through social media, engaging them through various fronts on ensuring that how they can use this. Time is a key. I think this would take time, because I think the understanding to the markets coming back onto the platform is a kind of a process which is something to be looked into, and therefore it takes some time of corporates or the SMEs or the participants in the value chain. The FPOs, particularly the aggregators, have not come in that way we should have. So largely because of the questions on the agri from the last so many years. So that's not been very vibrant, in spite that the farmer organizations can actually, the FPOs can actually use the derivative markets on the agri to ensure the crops, to ensure the price which they can get. So I think there are 2 points which I would like to put it across here. I would say for SEBI, means as we had it in the inaugural session, the 2 pointers here, that there has to be exchange regulator and the intermediary coming up together, NSIM 2 and ISM Institute 2, to ensure that engage with associations of these commodities. Means there are various industry associations we ourselves are doing, but it's a kind of a chicken and egg situation. So education can be multifold from SEBI as a regulator, the self-regulatory organizations which are exchanges, people like us and you from the academic fraternity, to help them understand the benefits in times of volatility of the price risk management. So the hedging would become a little better. And the second thing which I would like to which I would like to throw a question upon onto this forum is that these corporates and the value chain participants honestly are long dated people. Means they have their policies, they do transactions 6-7 months down the line, and our contracts are not liquid. Our commodity contracts, unfortunately, are not liquid for that far month contract. So we have the current month or maybe just the next month contracts, we have the liquidity, and the people are not interested to roll over their positions. And if you have the liquidity in the far month contracts, they would take action immediately. Say today, if they want to get into for something on the crude, 6 months down the line, they can, if there is a liquidity on MCX on these contracts, they can take a call. It cannot be every month they have to roll over positions. And because of the inefficiency, the rollover cost, you never know. And therefore, it might be the case which might impact the participation. So I would say the far month contract liquidity and the education from SEBI, the NISM Institute and people like us to join hands and engage with associations to ensure that these people, these value chain participants are onboarded. So that's the 2 things which I would leave it to SEBI's table or your table, sir, to see to it that how we can do this as part of it. And we are there in whatever way we can contribute in terms of our presence, in terms of our sharing our thoughts to these. So these are the 2 things which I would say we are continuously doing, but still we need to take it up a little different approach, because we haven't seen too much of traction with these initiatives which we have taken. And I think that's a very big business activity which one needs to see for the purpose of these derivative markets on commodities. So that's my answer to the price risk management. And two questions or two suggestions to you that you can engage how we can do together to ensure that these people come on board. So, thank you. Thanks a lot. If we have just 2 minutes, the last question to Dr. Shunmugam, and then we may get into the question and answer session. The last question, if you don't mind, the moderator on SEBI.
Sure, no problem.
Thank you very much. It's a fireside chat, yeah. So it means you really don't know how the time flies, yeah. So
Absolutely.
So I think we are making some sense in this discussion. If you think something else, we can come back with other thoughts too. So the last question in this 5 questions which we have prepared as a panel, I pose it to you. Very, very relevant question in today's time, Dr. Shunmugam. And I would ask you this question that although everybody is talking about technology and financial inclusion, to a large extent, the commodity markets in physical space, large extent, in spite of all the initiative from being a rural economy to an industrialized economy today, we still have questions on the financial inclusion, people coming on to participating, and the technology used for the commodity, not just the derivative, the commodity landscape, the opaqueness on that. So what's your call on that, sir? The digital push by the government, etc., would it change something? It is changing, but the pace is very, very slow, I should say, particularly on the commodities space. So how do you perceive this, and any thoughts on that account which you would like to place it on SEBI's, I would say, scorecard to work on, sir? So that's my last question to you, sir.
Thank you, Mr. Naveen.
The fintechs, particularly the fintechs, the regulation, the governance, the mobility issues, etc., has not been penetrated largely onto the commodities space. So what's your call on that, sir?
Okay, so thanks a lot for the question, actually. So I'll not take much time on this aspect, because as you rightly said, fire will not only be there in the burner, but it'll also be there in their stomach, actually. So they'll all be waiting for their lunch. I'm not going to stop them from the lunch. I'm going to answer in a very short and sweet way. Technology growth has been phenomenal in the last 5 years or so, primarily driven by the concept of Web3, that is peer-to-peer transactions, actually. So nobody has to actually go through a central validation. Maybe a validation which is done across the web could be enough for me to validate the transaction, in which I have transferred my position in the market, my money in the bank, or whatever that you may call my commodity which is there in the warehouse. I've transferred from me to the other party on the opposite side. That's an excellent thing that has come up, on the back of which the Bitcoins and the Ethereums of the world are coming up, because that's not actually the actual end result of this technology. And this technology is called Web3. And Web3 introduces us into a new world of blockchain, smart contracts, and things like that. And you won't believe it, about 2 months back, I just was scraping through the website of CFTC, saw the application of one of the exchange called FTX. FTX is an exchange which had applied for launch of crypto derivatives on their platform. Interestingly, so that's a platform which is going to remove you as an intermediary, So that's where even the intermediaries would have to be vigilant on what are the changes that are coming up, and how do I come in and this one. So anyway, it's an interesting model, and the development of that model is going to be looked into, and a lot would depend upon how the exchange would manage around so many millions of participants, which is being done through the brokers, actually. So that's another thing that we can still talk about. So there's a lot of things which is a possibility: the blockchains, the RegTech, and the SupTech, which Mr. Navneet had talked about, and the previous speaker had talked about, actually. And there are a lot of competitive solutions which can come up. On the other hand, even if you look at the Indian intermediary world, actually, the contrary to the regulatory ambitions or aspirations, intermediation is becoming smaller and smaller. That is getting concentrated into fewer and fewer hands. The smaller players getting acquired by the larger players and things like that. That's basically because of the larger compliance costs, actually. So the technology has a larger role in making this landscape not only much more vibrant, but also much more cost effective as well. So with this, I close my suggestion. And if there is any question, we'll be happy to answer.
Thank you very much, Dr. Shunmugam. So before you end your question and before you end your answer, I would say that SEBI has done a lot over the last few months, I would say, with respect to digital push. But at the same time, on the regulatory side also, I have seen the SEBI meeting up the retail people, the retail brokers just off late, from few days back, and asking them to control on the derivative side, the retail push, and something on the regulatory side. So one way it is good that people have come, we're getting millions of accounts every month open through this fintechs and digital push. But at the same time, without the knowledge and understanding, it might be a kind of doomsday for someday. People, if they don't understand it well, the kind of work which happens on the capital market, and therefore without understanding just plunge into with their free time to test waters on the capital market. So I think again the education would play, the regulation would play, and I would give a hats off to SEBI, in spite that we are opening accounts on retail push, but at the same time they're keeping the balance between the regulation, the risk, and the push through digital. So that's something which is really great. So homework for SEBI and us. Two of the things, because of these 5 questions, I would say is how do we engage value chain participants in a little vibrant way? That's the first question. What can be the thought process to engage these participants? That would be the second question. And third, and the most critical, is that we see a lot about equity, but we don't see too much on the media, on the commodities side. So something on the marketing needs to be taken care of, ensuring the benefits of this landscape, both from the physical side of people, because of the price risk management, and from the asset diversification side also. That how. So it means I would leave some things between NISM and SEBI and the exchanges to help the intermediaries, making up, people coming up, rather than just saying कि gold कहाँ जाएगा तो खरीद लूँ नवीन जी या बेच दूँ. So on a long-term basis, how they can make the markets little more depth oriented, and the participation wise, many people see. The AIF has been launched in 2017 when I was part of MCX, so we were all gung-ho that people would come with AIF. The AIF has not been a starter to a great extent on commodities. We were all looking forward since 2003 the PMS should come in. The PMS has not been a non-starter. So in spite of all the reforms have happened, but the things have not moved the way they should have. We would love as an intermediary to help the community to come through us and perform and do whatever they want to do on the platforms like MCX, NCDX, and BSE, NSE. But at the same time, there's something which in terms of marketing also needs to be done, both from the academic side, from the intermediary side, and largely on the SROs like exchanges and the regulator itself on the commodity. So with that note, we thank SEBI. Both of us thank SEBI. We leave the floor open on question answers. Thank you.
Great. Thank you so much, Mr. Naveen and Mr. Shunmugam. It was really fascinating conversation around various aspects around emerging technologies, commodity, and like international commodity markets as well. And with that, I already have a bunch of interesting questions on my side. I would like to take a selected few. Let me take this one. So it's a question by Akshad Bansal, and Akshad asked that in today's world, Russia and Ukraine situation, I heard that Indian oil companies does various deals with Russia to get the oil at cheaper prices, and USA is threatening to impose sanctions on us too. So what will happen if USA really imposes sanctions around like India for relationship with Russia? So I mean that's quite a fascinating conversations around like sanctioning and like international politics as well as commodity markets, since all three of these areas are very much intertwined together. So what's your take on this? Any one of you can take it.
Since you have answered this question, Dr. Shunmugam, I will leave it to you.
Okay. So, as I told you, told very clearly, actually, so US has so far not said that you cannot have any imports being done from either Iran, which is already sanctioned for the last 4 or 5 years or so, and Russia. The only thing which is stopping us from dealing with them is when you actually pay them the proceeds of the imports that you are making, you have to make those proceeds of that in those local currencies, actually, are in the currency which is agreed upon by them. And so usually if it is a bilateral, then you either pay the rupee or the rubles, actually. So how much of the ruble that we have? So whatever that ruble that we have is from the exports that we are making to Russia. So to a simpler understanding of a dollar that we are exporting to or importing from Russia, we are exporting only $0.50. So having said that, the $0.50 worth of ruble, which is around 35 to 40 rubles, would still have to be kept by Russia in terms of those. So Russia would not want that to happen, actually. So there would be a repetition in terms of, and US would never ever sanction unless and otherwise you entered into a sanctioned territory. So imports have not been sanctioned by the other countries, have not been sanctioned, but you cannot transfer the money across in dollar. That's the main thing that you have to understand. That beyond that, there is a lot many things. So I mean, this forum may not be appropriate for me to explain that, but obviously understand that you have to transfer it in rubles, and Russia may accept rubles only to some extent, and Russia too wants dollars. That's it.
I'll have something to add on, just a liner there. Not too much. Europe is still buying oil from Russia or gas from Russia. Means in spite of all those sanctions, they're not stopping their economy without of energy. So I think the sanction is a buzzword today. Means we have seen COVID as a buzzword for last 2 years. Sanction would be the new buzzword going forward. So I think it's a very free trade kind of a discussion. What is wrong is wrong. Means we are not saying whatever has happened is right or wrong. The point is that it's a free world. Europe has not stopped, in spite that they're looking forward for alternatives. Now, after this invasion, they have not stopped buying anything in terms of energy from Russia. In spite of all the sanctions being by the Western world. So I think it's an evolving situation. There are too much of things. We don't have to rely too much of what comes on the WhatsApp and social media. We have to rely on a couple of things which are of sanctity. But it's a little far-fetched that US can do something in terms of sanctions of buying us with discount oil from Russia. Nobody stops us that way, and I think that's evident with the foreign minister coming up from Russia sometime back, 2 weeks back, and meeting the officials here, somehow discussing the deal in terms of discount and how it can be worked out. So I think it's a little fair play, but then evolving situation.
So in addition to that, I will just add to one more point. US is still importing 16% of their uranium requirements from Russia, period. So
you can understand the number says it all. Means that
right.
The euro economy can't close down if they just slash. They can't import oil or energy requirements from that particular part of the world. So it means it's a little far-fetched thought, but beware of these rumors which keep coming in. So let's cross the bridge as and when it is.
Yeah, absolutely. I mean, like it was really well taken a point, and since like with the advent of time, I would like quickly move ahead with selected sets of questions ahead. We already talked about emerging technologies and its applications around commodity market, and especially about with the rise of Web3. So Akshat once again asks an interesting question, that in the world of Web3 and crypto, where the main motive is not to be like dependent on the intermediaries, but since like Yes, Mr. Navi.
You can answer. I was saying that I'll answer this and then maybe
Yes.
because I'm excited on this question, and I would say that means you can continue with the question. I was just raising the hand. I'm not willing to go to the restroom. I'm not raising that hand that way. I'm just saying
I'll quickly complete the question. So as I was saying, like in the world of Web3 and crypto, where the main motive is not to be like dependent on intermediaries, but since the government has like announced like 30% taxations on crypto, and there is still like doubts on what exactly is legal, and like there is still sort of like a gray area in terms of illegal and not legal. So what's your take around on this aspect of the crypto market?
So I would say that a lot many clients like mine on the intermediation saying, young people like you, I'm sorry to ask you your good name. It says SEBI Manthan. So is it Mr. SEBI Manthan or what?
My name is Sumit.
Sumit, okay. So Sumit, a lot many people have been asking about crypto. The technology on the blockchain has really helped people. It's an evolving technology, and evolution on blockchain has helped the digital part of the cryptos and other things. I won't talk about too much on the compliance and regulatory aspect of it. I would leave that question to be answered by Dr. Shunmugam, a learned professional in terms of that. But as I would understand, regulation is a key. I mean, the kind of we used to say 2 years before, in a globalized world, the globalized world itself is in a question. So I would say whatever has happened, but regulation is something which would be the key. Up till unless you don't have any markets which are under a regulated environment, it carries risk. It really carries risk, and you don't know, Sumit, really, or Akshat, really, that how it will going to pan out. Means it's a very, very volatile market. Cryptos, one day it is 60,000, the other day it is 30,000. So the risk capability, ability also would be the key thing for people to get into kind of Bitcoins and Ethereum, etc., etc. Very, very volatile. Some states, some countries, I should not say states, some states have accepted cryptos as official currencies, but we are far away. And we, being talking to our Indian audiences, I would say the risk capability is definitely one of the things one should see it. Just don't see it 30,000, 60,000, 60,000, 70,000. Just don't get lured yourself into returns and the price upward trajectory. So it's a very difficult play. As far as the legal sanctity is concerned, as far as I understand, anything which is in Indian jurisdiction, as the Union Budget press conference also said, that anything which is making some profit, the government has all the intentions to make it taxable. So they have done that without the intent that it is legit. Taxation doesn't mean that it is legitimized in terms of regulation. Means I think there is no regulator. Means crypto is being talked about, the bill, the discussions are still on table, but nobody has said that it is a regulated product, a financial product, to be part of it. So I would say that one need to be very, very cautious, honestly, Sumit and Sakat, Akshat, that yes, it can lure kind of volatility, can lure the returns, can lure you, but you need to be very sure where are you getting into and whether it is regulated or not. I would still say it is better to be on the sidelines than to be at the mercy of people to get your money back. So regulation is the key aspect which one should see. I leave it to Dr. Shunmugam in terms of whether it is regulated or what should we do.
Okay, we'll not go to that particular point. I'm completely agreed upon that. Anything which is unregulated is going to end up in a problem. And when it ends up in a problem, when it impacts the masses, there's nobody who's going to solve it, actually. So always in life, regulation plays a larger role, no doubt about that, actually. The problem with the world of cryptos is not the peer-to-peer transaction that has been enabled through the Web3. The problem in the crypto world is the anonymity of the transactions which has been sought by the people who are transacting them, actually. Unless you know who has transacted what at what price, how would you regulate them? So that's the basic question that we are ending up with respect to cryptos actually. So if it is a peer-to-peer, not reported anywhere to any of the regulators, then how would I, do what needs to be done in order to basically bring the market to, in terms of this one? That's number one. Number two, the regulation also determines what is a socially acceptable behavior and what is a socially deviant behavior. Okay. So having said that, actually, so I'm not saying that. So that's where, I'm just going to, cross the line and get that into the other question that I could see that on the other side, which is in terms of socially acceptable and socially deviant. India has been voting against the crimes that is happening, which is being committed by the Russian forces in Ukraine, actually. So in the name of supporting a humanitarian crisis and completely shutting us off as the West is dictating, we are going to end up in a bigger humanitarian crisis if we have to abide by what the West preaches as what are the sanctions that are there. And thankfully for the government and the thinking process which is there, that's not the case actually. Okay, so having said that, should we use not use the SWIFT or the Fedwire system in terms of transferring the dollars? Should we use the cryptos? Not at all, actually, because that's an area which is something anonymous. You don't know which drug dealer, which cyber attacker, which illegal deal provider in the market is going to end up receiving the money on the other hand, and that's going to result in socially deviant behavior. So in that case, no, not at all that it should not be promoted from a nation-to-nation transaction. But in return, what I would suggest is there should be some sort of an alternative in terms of transaction channels that would be available. But let's see how the Web3 world, which is more emphasized on the peer-to-peer transaction, evolves in terms of being regulated to the extent that it doesn't go and support the socially deviant behaviors. That's it.
Absolutely. I think Dr. Shunmugam, that's quite an interesting point that you put forward. And then as we discuss about Web3 and evolution around these technologies, the major aspect becomes areas concerning anti-money laundering and a source of funds in terms of source and where exactly these funds are getting utilized, which in a decentralized world, it becomes practically difficult for any regulator to trace that. But it's really great that Indian regulators are taking active steps in terms of policy considerations, working papers coming out at a consistent basis. And we are actually seeing that all the various regulators are coming forward, at least understand and not just shun out this technology completely, but majorly understand and see how it can be used in a better way to advance the overall financial markets for the future, for the next couple of years, for the next decades ahead. With that, I would like to take one final question, which is by Mr. Adesh Singhal. So Adesh talks about the gold spot markets. I'll quickly run through in terms of an overall example which he has given. It's quite an interesting example which he has put forward. So Adesh recently went to a jeweler's shop and he asked for the price for a 10 grams of gold coin. And on that particular date, he was told that the rate on the he was quoted that the rate was MCX plus X amount. So the question comes here is at the MCX rates are the future rates, and we can't ignore the fact that there is majorly it's majorly based on the speculation. And how gold spot exchange will help in better price discovery, and will it be helpful in removing such speculation effect on the price of the gold?
I think I will leave it to Mr. Naveen to respond because.
Okay. I was thinking about that since the spot exchange is something which is coming up. I think I'll tell you one thing. There's no denial, Sumit. And I just see the question being posed by Adesh. So there's no denial on it that that MCX kind of has become a little benchmark to the pricing. At the same time, I would also say that in spite that the larger participation is, I would say, traders or speculators, but I'm not saying that the participants are not from the value chain. So since I was heading the business development function at the exchange on MCX, I've seen people from the jewelers, people, corporates, very big corporates who are engaged in bullion, doing their price risk management or participating on MCX. So it is just not the speculators market. It is a mix. What I tried to ask earlier was that can this mix be tilted towards a kind of a 50-50 or a developed world where the value chain participants are participating to a little larger extent, which is still missing. Having said that, I would say that the bullion exchange, which SEBI and the government of India is looking forward to, the global, I would say the depository receipts, kind of the gold depository, or I would say these that physical gold on the bullion, the India standard on the bullion would surely help, would surely go a long way in transforming even the spot markets, which are run today by people in gold. So it means if you have a bullion market, a well bullion spot market, I would say that these would be something to be looked into, and it would normally would be taken in a right perspective from the angle of pricing. So spot plus whatever your charges are would be the key to be looked into if we have very effective spot bullion exchange, which anyway has been announced. The work is going on in that direction. So if it can be sped fast, I would say, I'm saying from a particular reason, because the bullion market is pretty huge in India, and if we can work something around on the bullion spot exchange, the setup and the efficiency to be bring in, Sumit, it will go a real long way. I would say that the spot opaqueness also, even in fragmentation, means I would say the fragmented bullion market would take cues from this spot market, deliverable market, and everything therefore would be benchmarked to the bullion regulated transparent market. So I think bullion exchange definitely would be the key going forward. How fast we can transform that would be something to the implementation side of the business as to how fast that can come in. So with that thought, I would say there's nothing wrong. The last thing to say, the bullion on the MCX is close to 97-98% correlated. 97 to 98% correlated to the international COMEX prices in dollars. So if you have that particular Excel sheet in front of you, you put in your dollar price in COMEX and or the London, and with all the costs, import duty, whatever you see the price in India market. So it's a very efficient market because of the volumes. Per se by volumes, just not the MCX, the spot itself. It's fragmented on pricing, not too much today. The Bullion Association sets pricing every single day at the start of the day, and everybody has to follow that pricing. So I'm saying it's very much correlated, honestly, Sumit, and there's nothing which is wrong in here, but bullion exchange would surely serve a great purpose for markets to get developed better in bullion than what we are today.
Let me add one more perspective to the question that, in addition to what Mr. Naveen had tried to answer. So you rightly went and asked Mr. Atish if you are there in Mumbai to a Mumbai Chola, correct? So having said that, you should know what MCX is trading on. What MCX is trading on is Ahmedabad delivery, actually. So that's one part which might add to that X factor. So compared to the previous situation, wherein this industry was actually dictating a price, now they have moved into MCX plus X model of pricing, actually, The question is, MCX cannot be manipulated. This X factor is something you need to be sure about. What is this X factor which you are giving out? And this X factor is coming, as rightly said by Mr. Naveen, because the markets are fragmented. Mumbai is based on Mumbai's demand and supply. Ahmedabad is based on Ahmedabad's demand and supply. And it'll take some time for our markets to mature and reflect all into only one price, actually. And that can be enabled by the spot market, because the spot market, end of the day, is not worried about, will not be worried about the liquidity, because it can launch any contract which is for Mumbai delivery, which may be for Chennai delivery or Bengaluru delivery or Ahmedabad or Delhi delivery. So it doesn't matter where it is getting delivered, and the prices will be discovered based on which city you are talking about, actually. So yes, definitely coming up of the spot markets with the coming up of the spot contracts, which will be delivering gold at that price in those places, will definitely add value to, in terms of you benchmarking your transaction to the jeweler that you are going and talking to. Thank you.
Great. Thank you so much, Mr. Naveen and Dr. Shunmugam. That was quite a fascinating conversations around even bullion markets and the gold markets. And with that, as much as I would have loved to take more questions from the audience side, which I already do have, but with the advent of time, I would like to thank you all for joining us. With that, I'll briefly quickly run once again about the Manthan program, which we are setting up. So
it's a great idea, Sumit. It's a really great idea.
Absolutely, and with support with folks like you, it's always been looking forward to a larger success and creating a larger ecosystem in terms of ideators and innovators coming together and building products for innovation within capital markets. And when we talk about innovation within capital markets, these are the four major themes areas where we are looking forward to in terms of ideas and applications coming in, from investor education, protection, and ease of investing, on the securities markets development, market regulation, and integration within the financial ecosystem at scale. And as I already mentioned, there are cash prizes worth up to 5 lakhs, which is up for grab. There is participation certifications for all the applications who complete their application process, and along with that, free goodies, special edition goodies as well. In terms of timelines, once again, today is 9th April, which is the first masterclass. Make sure you are attending the other 3 masterclass as well, which is on 23rd, 30th, and the 7th of May. And make sure you are submitting your applications before 14th of May. And with that, in terms of who you should apply, or who is it relevant for, I think if you are an ideator and innovator in terms of any of the domain areas, irrespective of where you are currently working or studying, if you think that your idea can help better the capital markets in one way or the other, we would like to have a conversation with you. We would like to have see your application and have a discussion with you.